stocks are going to grind higher. We think that's a trend that's got legs.
There's still room for the market to price in further easing and even rally a bit along the curve.
There certainly is. Over the longer term, this kind of big is going to do better theme.
It's not a time necessarily to be either, aggressively on offense or defense.
We're waiting for data that will confirm one of these narratives, and you just don't have the data in yet.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Your equity market pulling back just a touch after yesterday. 5-day winning streak on the S&P 500. NASDAQ 100 highest since January 2022. You want some levels? Two names. Microsoft, record high. NVIDIA, TK, all-time high. Going into results a little bit later.
Thinking of buying my first share today. We'll have to see off the earnings as well. How stupid is this? Here's where we are. We're going to inform you on tech today without all the absolute insanity of the last 3 or 4 days. Some great guests on that. NVIDIA on the Bloomberg, the PE is 117, and they're growing so fast, John. The view out 1 year, the estimated PE is a 46. I've never seen that.
Absolutely nuts. The stock is up by something like 240% so far year to date for 2023. It is the number one performer on the S&P 500. This from Jim Reed over at Deutsche Bank Bramo. Q1 earnings from NVIDIA in May was probably the event that catapulted AI into the stratosphere, which is why I think for a lot of people this is the main event this week.
That was well said, especially because it wasn't just about the returns in that quarter. It wasn't just about profits. It was the forward look. If they give us another forward look that outperforms by 25 to 50%, what does that mean about how much we're estimating or underestimating, I should say, the potential for AI?
Totally agree. And after the Microsoft madness of the last 48 hours, 72 hours, it will be nice to have a normal conference call with a guy who everybody worships, who has an actual board that supports him, unlike the dance we've seen the last 72 hours.
Can we avoid the open AI obsession?
We're not doing open AI at least until 6:03:30.
A bunch of tech bros pretended this is the most important story they've ever covered. It's as if they're covering a war.
It's embarrassing.
There's an actual war taking place.
Right.
That's the news we need to cover this morning. Hamas saying the group is close to reaching a truce agreement with Israel. Tom, this could happen as soon as today. This is a story for us.
That's a story to cover. Anne-Marie Horton and others will brief us on that. And there are other stories as well away from what I think is perceived by adults, and Dan Ives used the word adults, is the immaturity of the dialogue of so much of this open AI thing. I mean, everybody read Satya Nadella's biography to find the adult in the room. He's had huge family challenges with illness and with kids. He loves cricket. He's devastated. All this, he's devastated. Australia beat India in cricket, and then he's got to go deal with these kids, this board.
I think maybe the fun of that is partly a reprieve from the misery that a lot of people have been feeling with some of the other developments, including the war and the uncertainty about the broader parameters of what we're looking at next year. It's much more fun to focus on stories of promise and dysfunction and craziness than it is to all of the other stuff that's very real and that could potentially shape the narrative for next year.
A full coverage of some of those stories throughout this morning. Let's get to some of the price action. Pulling back just a touch on the S&P 500, negative by 0.1%. Yields coming in a basis point or two. Your 10-year 440.43. The euro creeping higher once again. The euro at the moment, TK 109.44.
My leading statistic here off the Bloomberg Launchpad is the 10-year real yield, shocking, 2.11%, really pounding down yesterday, John, to a new low. And we begin to frame out like euro 110, 111, sterling 127. Could we get to a 1.99 10-year real yield? That would be a year-end shock.
That speaks to the dollar weakness that we've seen over the last 4 days. 4 days of euro strength, believe it or not. Lisa, 4 days of euro strength, the longest streak, going back to July. That's kind of how rocky things have been over the last few months.
I believe it, considering the fact that it's been basically range-bound for a number of months now. Just letting you know what we're looking at going forward. We are getting a whole host of retail earnings. We did just get Lowe's. I'll go over that in just a sec. Kohl's, Dick's Sporting Goods, Best Buy, Abercrombie and Fitch, all the before the bell, Nordstrom after the bell. Just want to pick up on Lowe's. Those shares lower by more than 5% after they came out, seeing the full-year adjusted earnings per share at $13 versus a higher range earlier. You're also seeing comp sales lower. So So we'll parse through all of these earnings and get more detail on that later. 2 p.m. Fed meeting minutes from the October 31st to November 1st meeting. People are making this into something that maybe it's not going to be. I'm just going to throw that out there because people are expecting maybe the Fed to push back against the rate cuts that are increasingly getting priced into the market. We'll see. After the bell, I agree with you, John. To me, the story of the day is NVIDIA earnings. Absolutely, 100%, given the fact that they have colored the narrative over the promise for artificial intelligence and the monetization of that. They have been at the front of that game because a lot of companies have been trying to hoard chips from NVIDIA before anyone else can get them.
And then they've had an abrupt competitive response from the others. I really can't say enough how maybe the linkage here to all this silliness with OpenAI is Microsoft needs to build 2 chips to compete now with NVIDIA. The now is the key word there.
Easier said than done.
Yeah. And they've made clear on that.
Without a doubt.
They're humble about it. I'm not
Without
getting
a
a lot
doubt.
of attitude here.
Joining us now to discuss, Marky Patel, Senior Portfolio Manager at Allspring Global Investments. Marky, you hold NVIDIA, so let's talk about it. The narrow dominance of this equity market in 2023, do you see reason for that to continue next year?
Yes, I do. Unfortunately, it would be nice if we had a broader range. But really, I think we're going to be looking at modest growth next year. And that says that only those companies that are in sectors that have above average growth are really going to continue to participate. Just like this year was dominated by a handful of stocks. I think that trend is continuing.
That's right where I wanted to go, Margie. My theme for next year is our cumulative 2024, stealing the concept from the great Lyle Brainerd. And I see a cumulative 24 months. Or 36 months or more out of these tech leaders. You are conservative. You are income, equities, dividend growth. Can you own large technology because they're going to do it again next year?
Yes, because many of them do have dividends, and some of them actually have competitive dividends. And also they have the ability to raise dividends or start dividends, which some have started to do. And at the end of the day, you really want stocks that go up in price to increase the value of your holdings. So, yes, we do like tech, and we do like some of those companies, even if they pay a small dividend.
How much is that bullish view predicated on the idea of rate cuts next year?
Well, honestly, I think the Fed is really kind of irrelevant in what's going on in the economy. The economy moved slowly and inflation has come down. Personally, the Fed had very little to do with it. So I think we're going to be really in a trading range with treasuries, 4.5% to 5%. And the economy is going to do what it does and not really be affected by the Fed.
So given the fact that you do think it's the economy, stupid, as some people say during the election cycle, how important are things like NVIDIA earnings after the bell to give you a sense of just how much more promise there is baked into some of the names?
Yes. Well, it's a hugely symbolic name. There's so much emotion and passion built up around this name, particularly around earnings tonight. It's hard to think of another company where we've all held our breath to see their earnings. But definitely a big indicator of this continuing strength that we should see in artificial intelligence. But I think even if it's disappointing for some reason, the market is still going to be stronger through the end of the year. Really.
Thanks, Margie. I'm just going to jump in with SocGen's latest outlook, which just got published. I'll share some of the quotes with you. The narrow breadth in equities will likely continue until a recession begins. This is going to be the conversation, Tom. John Stolfus from Opco out yesterday saying he expects a broadening out. What's going to trigger that broadening out? Basically, SocGen's out with this call saying it will take recession. They expect a mild recession in the middle of the year, a credit market sell-off in 2Q, and ongoing QT. That's the call from SocGen.
And Ellen Zentner of Morgan Stanley publishing moments ago talking about the same slowing growth. And I do think particularly for all of us with retirement plans, those behind, those ahead, whatever, is the arch issue here is breadth or continued tech leadership.
Well, this also goes to the sort of point that everyone's saying, go with what works. And what's worked so far is this narrow leadership. And at this point, it works until it doesn't, which means recession. Nobody can game out when the recession is going to happen. So then how do you decide when to get out?
Margie, does it take a recession before we start to see a broader participation in this equity market?
Possibly, but that would really mean stocks have to go a lot lower for some of those sectors. The problem when you look at the market about being very narrow is a lot of those other sectors really have problems. Utilities, materials, even healthcare, they're in a downswing. They don't have anything that says they're going to turn around. So it's hard to see why they would be attractive compared to technology or some other tech-related industries that have high growth. So no, I don't see a change really.
Margie, I want you to speak to the people that took the Kool-Aid and bought bonds. They bought laddered maturities. They got single-digit returns. Explain to them, the bond people, how they need to have some equity growth in there as well.
Well, that's true because the absolute level of yields right now are very low. You can't say if you go back a decade or 2 decades where you could get 8 or 10% from corporate bonds or high yield bonds. Today you can't. Even junk bonds are, say, 7 to 8%, a little discount. Reasonable value but not outstanding value, and really not competitive to an above average stock, frankly.
How do you avoid the dividend trap of the yield hogs, the things that are high yield but troubled? How do you avoid that in 2024?
Well, I thought people would have learned that lesson, Tom, from the financial crisis, that buying a big dividend doesn't protect the value of your asset. So really, I think the best way is to look for companies that can grow, that can modestly grow their dividend over time, and really look more for capital appreciation, ironically, at a time when people seem to be very focused on income.
Margie, we've got to leave it there. It's great to catch up with you, as always. Margie Patel there of Allspring Global Investments. Want to go back to Lowe's, the full-year outlook. Missing estimates by a mile. They now see -5%. The range previously, Lisa, was -2 to -4. The estimate was -3.44. Stock's down more than 5%.
And they're citing a decline in do-it-yourself spending for the decrease that they're seeing in comp sales and the forward look ahead. So there are two questions here. Is this because people have already done all of their do-it-yourself projects? Is this because they don't have the money, or because they don't have the will, or some combination of all of the above?
How does it stack up versus Home Depot? Bramo, isn't that a question we've got to ask?
Is it the same kind of mix? Is it more tied to the housing cycle or less? You're right. Is this just an execution issue, especially because margins came in significantly lower than they expected and will continue to for the rest of the year?
The market speaks. Home Depot's got a 19 multiple. Lowe's has a 15 multiple. That's all there is to it. Home Depot's taken as a premium price. Margie Patel, John, her percentile 5-year track record is 84th percentile. She is one of few standing. I mean, she is a rare duck with an 84th percentile 5-year off the Bloomberg.
Holding NVIDIA will help you this year.
Not being courageous not to hold bonds. That's the heart of Margie Patel's legendary excellence.
Well, typically we'd associate Margie with bonds or recently shifting towards equities.
In the last 3 or 4 years, she has made a massive shift towards a
much bigger way. Yeah. There are things that matter to the economy. We'll talk about jobless claims tomorrow. That could well matter for the market as well. But the thing for this market, Lisa, has got to be NVIDIA after the closing bout, delivering earnings a little bit later.
They've just basically knocked it out of the park again and again. People have incredibly lofty expectations, and then they beat them, and then they tell you that they're going to be even more amazing, and then they beat those. Again, it goes to this monetization. How long can they continue to monetize the promise of AI in the way that they have over the past few quarters?
Their EBITDA margin is only 57 cents on the dollar.
It's amazing. It's just amazing what they've done.
I got to publish 57 cents on the dollar.
It's almost unbelievable. That was what the first quarter, the numbers that came out in May, was just sort of blew this market away, Lisa. There was just this feeling that it was too soon to monetize this effort, and then it started to happen rapidly.
That's exactly the point, is that people thought, okay, this is something in the future that we'll figure out the applications and then we'll figure out who the winners are. And it was quite clear that NVIDIA was monetizing on it now. And one of the sort of discussions that people are having, companies, businesses, a lot of countries saying we need to get in on this before the chips become obsolete.
To this cumulative theme, I go to 2019, pre-pandemic 12 billion revenues, running at 54 billion right now. That's better than good.
NVIDIA year to date up 245%. Coming up on the program, Rishi Jaluria, software equity analyst at RBC Capital Markets. That conversation up next from New York City this morning. Good morning.
We are leading in this next generation of AI technology. We continue to be committed to OpenAI, and we continue to be committed to Sam and Greg and the team, irrespective of where they are. We definitely will want some governance changes so that, surprises are bad, and we just want to make sure that things are done in a way that will allow us to continue to partner well. That's about it.
Surprises are bad. Satya Nadella, surprised, speaking to Bloomberg's Emily Chang. OpenAI in talks to unify the company now after hundreds of staff threatened to leave following CEO Sam Altman's firing. In a letter to the board, employees writing, quote, "We are unable to work for or with people that lack competence, judgment, and care for our mission and employees." Microsoft hiring Altman to lead a new AI group. Rishi Jaluria of RBC Capital Markets saying this: "We believe this ultimately benefits Microsoft as it retains its AI halo and further controls its destiny. They're actually in a stronger position now, Tom, than before when it comes to AI." RBC, an outperform rating on the stock, 390 on shares of Microsoft, Tom.
Perfect quote to pick here with Rishi Jaluria. This is the interview of the day on this, folks. We're going to talk to an adult right now of the melding of all this. How do you get to NVIDIA, which Mr. Jaluria does not cover, over to the software world of Microsoft that we think we know? Rishi Jaluria out of Berkeley and Ross School, Michigan, at RBC Capital Markets, ex-JMP, which is a boutique firm of incredible ability. Rishi, honored you're with us this morning. Okay, they're going to walk in, 2 guys, 5 guys, and 500 engineers, and they're going to make 2 chips or whatever to compete with NVIDIA. Let's start with the why. Why does Microsoft, ginormous Microsoft, have to compete with NVIDIA?
Yeah, and thank you so much for having me in the warm introduction. I think there's 2 reasons. Number one is the unit economics. We can all look at NVIDIA's gross margins and obviously the amazing rally the stock has had and the revenue growth. And Microsoft knows that there's a lot of ability to save money and bring down costs. But I think the more important factor of why they want to bring in their own chips is because there is a major GPU shortage out there. And you are in a situation where it is hard to meet demand. And because of all of this, costs are prohibitively expensive for generative AI. And that can actually be a limiting factor. That's a piece I've talked to when I've had my conversations with companies, is a lot of companies want to go down the route of adopting generative AI in a big way, but the costs are what stop them. By my estimates, a generative AI workload costs about 5 times more than a traditional cloud workload. How do you bring those costs down? It starts with the hardware. And you want to bring that cost curve down to make it more useful. And ultimately, you get generative AI to become a much more prevalent technology.
On a percentage basis, how NVIDIA-ish is Microsoft? Is it a 2-3% bolt-on to Nadella's ginormous company? Or can it be, out 3-5 years, a germane part of Microsoft? Compare the potential size of what Altman can do to the total of Microsoft.
Yeah, from a broader AI perspective, this is going to be more like the cloud. And that's the big thing about AI, is it is that seismic technological change, similar to what we saw with the cloud. Look at what happened to Microsoft when they were an on-premise company. Look at where they are as a cloud company, not just their stock price. Look at their revenue growth, look at their profitability, and look at their relevance in the technology world. And I think AI can be a similar accelerator. And the great thing about having Sam and Greg and whoever else joins, if this is how it proceeds, and obviously this is changing by the hour, that Microsoft not only is continue to be a leader in AI, they're actually in control of their own destiny. That was, I think, one of the few knocks that people had against Microsoft, is they didn't control their destiny. They were up to OpenAI. Now this happens kind of all internally. So this can be a major accelerator for Microsoft, and I think this can be a much bigger company as a result.
Rishi, I'm still stuck on this idea that it costs about 5 times, based on how expensive some of the hardware is for generative AI, to get certain workloads done as it does the traditional means of just hiring people. Does it basically mean that NVIDIA's success so far is the reason why the Microsofts of the world, the software-focused areas, have not been able to monetize AI in as material a way?
I don't think it's because of the GPU shortage. I think that is one factor. And by the way, I would maybe push back. I think Microsoft is monetizing AI in a big way. By my estimates, AI is already a $500 million ARR business for Microsoft after 2 or 3 quarters, which is kind of an amazing unheard of trajectory. For the rest of software, however, I think there are a couple reasons. Microsoft, remember, has a huge head start when it comes to generative AI. They invested in OpenAI back in 2019. A lot of other companies are playing catch up. I think a lot of enterprises are also maybe have concerns around data privacy, residency, and they just, security. And that's also a limiting factor. And I think maybe lastly is a lot of companies are figuring this out. Remember, generative AI is a little bit of a blank canvas, and you have to figure out the right way to use it. Think about the way you and I use ChatGPT today versus what, a year ago when it first got launched. Part of it is obviously it's gotten more powerful, but part of it is we've had to figure out what's the right prompts to ask it, what's the right way to tweak it. And, with APIs, it's maybe 10 times more complex and difficult. I think the monetization is going to come. I just think for software, it's probably a 2025 event when it starts to be material for, the HubSpots and the MongoDBs of the world. But for Microsoft, I would say it is already material and rapidly going so.
When you keep talking about GPU, it's a graphics processing unit, one of the key components for some of these chips that are required for generative AI. Do you think that Microsoft can materially get into the chip creation, the physical world, the hardware game as it ramps up to the software monetary prowess?
I think they can. Now, I would say they're not going to be directly selling GPUs to customers in a big way. I think it's more of you can rent out GPU capacity via Azure, and this becomes a boost for the Azure business. This becomes the preferred cloud vendor to run generative AI workloads, not only because they have, the best AI technology out there, including all these Azure OpenAI services that they're already monetizing, but now they're going to have more and more capacity and again, at a competitive rate versus how things have been. So I think this is more of a unit economics for Microsoft and a boost to Azure.
Rishi, it's a slow day here. We got to make some news. Everybody's piling on Microsoft now. It's one big love fest. We're on our way to $3 trillion. I think it's 404. You're at a 390. The well-dressed Dan Ives and the rest of them are up there. Are you going to be adjusting a higher here when you see this unfold? Can we get you out over 420 on Microsoft right now?
Obviously I can't comment on any price target changes that are may or may not bring. I would point you in our note, we do talk about, a bull case, which would be beyond that. And, you can kind of draw your own conclusions.
Oh, come on. Nobody's listening. We're among friends. What's your bull case? Give me a number here. Can you out-Ives Dan Ives?
Look, my bull case, in the note would be above $400 a share. I think the thing we have to say is right now, I'm not modeling huge generative AI revenues in my model. If we start to think about Office 365 Copilot, for example, that's all kind of gravy on top of this. And I haven't even really brought in, calendar year 25, calendar year 26 numbers. So again, I would say you can draw a lot of conclusions based on those sort of things to get you significantly above where the stock is today. But published price target, $390.
Rishi, thank you. Compliance is still in bed. Don't worry about it. Rishi Jaluria of RBC Capital Markets. They wake up at about 8:30 TK.
Stephen Ross, he owns a small real estate company called Related. And to be clear about it, started with next to nothing. It owns a small football team, I believe, called the Dolphins. And he set up shop at Michigan, where Rishi Jaluria went. And they do factor-based. They do acuity. They do acuity like nobody. That's what you heard there from Jaluria.
This was a free-for-all
every segment
yesterday. A recruiter's dream. Mark Benioff out on
Did
Twitter
you see
yesterday.
That?
Salesforce will match any OpenAI researcher. I didn't. Who has tendered their resignation to immediately join our Salesforce AI research team. Like everyone was making an offer.
And there's got to be 10 other guys like Benioff that aren't getting the press.
Oh, Lisa, absolutely.
And so then you got one of the board members being like, sorry, I'm really sorry that I did anything that would make this a problem.
Ilya. Well,
Ilya,
he's
please,
more than a board member.
It's okay,
He's
right? He's the chief technology analyst. Yeah. I regret it all. Let's keep together. Kumbaya. Come back.
Goodness. What a mess. What an absolute mess.
My answer is to do what surveillance has been doing, which is talk to adults, like Rishi Jaluria, their encyclopedia.
Talk to adults and / ignore it. Sometimes.
Ignore it. Yeah, exactly.
Lindsay Piegza of Stifel joining us ahead, just around the corner from New York City. This is Bloomberg. 5-day winning streak on the S&P 500. Equities look like this, pulling back just a touch. Big earnings report after the close later on today. We'll talk about Nvidia throughout this morning. Equity futures down by 0.1% on the S&P. On the Nasdaq 100 going absolutely nowhere. Yesterday at the close, the highest level since January 2022. I believe, Lisa, here just a few percentage points away from record highs on the Nasdaq.
Which is not how it feels, right? I mean, basically, we're not talking about new record highs, and yet it shows that the Magnificent Seven have driven so much of the gains, and guest after guest says that that's probably going to continue with this narrow kind of leadership.
A Microsoft all-time high, Nvidia record high. You can thank the bond market for some of this yesterday. Bad things didn't happen. I wouldn't say good things happen. I'd just say bad things didn't happen. At a 20-year auction, Lisa, no one talked about it. Good news.
Well, it actually was better than people expected. It actually traded with yields going lower after it came out. And this was actually one of the bigger market movers yesterday. Of everything else that came out, people wanted to know about the auction, Tom. Just letting you know, people care about the auctions.
The equity market seems more excited about that bond auction yesterday than the bond market did.
Yes, exactly.
Which is kind of odd, TK. This has become a market mover over the last few weeks.
To go to Heilbronn and Bernstein, it's the debt and the deficit. And it's tangible. It's real. I mean, the people that you would expect talking about the debt and the deficit are, but there's a whole new cohort of people going, wait a minute, how bad is the situation? And that's where you get to auction analysis.
Let's finish on foreign exchange. The euro, let's see if it's still stronger. Was a little bit earlier this morning. It is.
Wow.
Just about 109.41. You get another day of strength here, Tom. I mentioned this a little bit earlier, but if you are just joining the programme, 4 days of euro strength, longest streak since July, the middle of July for the euro.
John, things are changing. I have only one data point today, folks, and it is the inflation-adjusted yield on the 10-year. John, moments ago, 2.0966. We have a plunging real yield. It's a huge, huge deal.
And that's what's weighing on the dollar and arguably supporting the euro move over the last few days.
To me, it correlates in with all the other movements in equities, bonds, currencies, commodities, and we've got a lower real yield. There's no other way to put it.
Let's get you some news. Under surveillance this morning, a potential breakthrough in the Israel-Gaza war. The leader of Hamas is saying the group was close to reaching a, quote, truce agreement with Israel, suggesting progress is being made in talks to free some of the 240 hostages held by Hamas. Bramo, we're making some progress.
And the goal here is to have some sort of multi-day or multi-hour, at least, ceasefire to also get humanitarian aid in. I got to be honest, I am struck by the amount of misinformation on this story. I am struck by the way that this is being disseminated across a whole host of different social media platforms. To me, this is going to be one of the reckonings after the war, after the dust, after the blood, after the gore.
Guess
How do we perceive things?
We didn't have social media at Guadalcanal. How do you run a war with social media? And the answer is no. I'm not being smart. Nobody knows. Nobody knows how you prosecute a war, John, with social media. It's all original.
We're all hoping we make some progress today. So let's just keep an eye on this story as it develops. The latest there on the Israel-Hamas war. Your next story, OpenAI, saying it's in, quote, intense discussions to unify the company following the firing of CEO Sam Altman. Microsoft CEO Satya Nadella, Altman's new employer, telling Bloomberg's Emily Chang he wouldn't be opposed to Altman returning to OpenAI.
We are leading in this next generation of AI technology. We continue to be committed to OpenAI, and we continue to be committed to Sam and Greg and the team, irrespective of where they are.
So, Sam Altman is now at Microsoft, but he can go back to OpenAI, 1. And 2, Satya Nadella still doesn't know why he got fired. I find that absolutely amazing. How does this guy, with a massive stake in that company, not know why the CEO was ousted on Friday?
And the way he basically confirmed that, we're a little concerned about the board composition, considering that we have very little visibility and surprises aren't good and we have no clue. And either way we win, but, it's not probably pretty good. I mean, that was basically what I heard from some of his comments yesterday.
There's so many stories associated with this one, Tom. I just sit there and shake my head as I'm reading it.
I'm doing a lot of, seriously, I'm not trying to be smart, but the tech frenzy over this, the hagiography of it is just too much for me.
It's embarrassing.
I'm shaking my head a lot. I like to talk to Rishi Jaluria about what it actually means for the future, including for these wonderful, bright American engineers.
Agreed. Less of the palace intrigue and much more of that.
What are the engineers going to do here to make life better?
Let's get to Nvidia.
They do okay there.
Big story after the close. Closing at a record high to start the week ahead of the chip makers' earnings report after the bow later. Nvidia has risen more than 240% this year, pushing its market value above $1.2 trillion. Investors betting on another upbeat forecast buoyed by demand for AI computing. Elisa, I was going through the weightings on the S&P and the Nasdaq. Number 4 weighting now on the S&P and the Nasdaq 100 this name after this massive move this year.
How much can they continue to give these incredible forecasts, right? I mean, to me, the forecast is going to be the key component of the earnings. Yes, they're probably going to beat. That all seems to be the way that things go, and probably beat by a big margin. Does that matter if they don't come out with some kind of outlook that is such a massive, significant increase over previous projections?
Yeah, the leaders are there, like NVIDIA. But the other thing is the other 30 stocks have gone up ginormous as well, just not stupid ginormous. But it's like you mentioned earlier, John, the Nasdaq's almost back to highs. I mean, that's a huge Q4 catch-up.
To Lisa's point, though, TK, we've been raising the bar for this company every single quarter, and they've just knocked it out of the park. Every time.
It's in all the stuff we have. I mean, I've got an NVIDIA and a computer at home. I don't know what it does. It says it's black and it says NVIDIA on the side.
Did you read about Saudi Arabia buying up chips as quickly as it could from NVIDIA so that they could be ahead of artificial intelligence?
Isn't that what's happening?
Exactly.
Sort of stockpiling this stuff.
That's
you doing
my
it at home,
hunch.
Under your tree?
Yeah, same. We're just aggressively buying NVIDIA chips at home.
Hanging them on the tree.
And putting them in little Tiffany boxes to hand out
that's good.
Family and friends.
Let's save the show here right now on economics, which is what matters right now as we go to a December Fed meeting. Lindsay Piegza joins us, chief economist at Stifel. Lindsay, I got a real yield from a minus 1%, called a year and a half ago. Up we go, and we're rolling over. What is the significance that the inflation-adjusted real yield is down to 2.09% print about 20 minutes ago? What does that mean for Jerome Powell?
Well, I think it shows that we are making progress in terms of taming inflation, bringing inflation off of those peak levels. But I don't think the committee is ready to celebrate quite yet that they've reached a sufficiently restrictive level. We've seen a lot of head fakes in inflation. We've seen a lot of volatility in the long end. And remember, there was a lot of argument that this backup in longer-term yields was going to be the final straw for the Fed. It would do the last tweaking of monetary policy, doing maybe 25, 50 basis points of the Fed's work for it. But that recent pullback that we've seen on the longer end, particularly in the 10-year, suggests that a lot of that run-up may not be a reflection of structural factors such as fiscal deficits, but more a reflection of changed expectations for Fed policy. So this may mean that there's ample pressure, still pressure on the Fed to take further action rather than enforce a more patient Fed, as the market seems to anticipate.
They've got a mandate of the labor economy and inflation, interest rates, if you will. Do they have a mandate to look at real GDP? And if it's slowing, is that germane to the conversation?
You know, the Fed has a very strict mandate of stable prices, full employment. Right now, the labor market, yes, the imbalance is extremely wide, but we are seeing progress. That being said, it's still extremely tight. The Fed can check the box on full employment. So the focus right now is entirely on inflation. Doesn't matter if GDP is slowing from a 5% pace, likely down to half of that by year end. That's an indication that earlier Fed policy is finally having the desired effect. So the Fed doesn't specifically target GDP, but the Fed does need to see a period of below trend growth in order to ensure that we are having that intended effect, slowing consumption, slowing investment, getting inflation under control. So that's a step in the right direction if we do see top-line GDP slow meaningfully from that third quarter report.
I'm looking at Fed funds futures right now, Lindsay. There is a 0% chance of any further rate hikes going forward. You basically implied that you would push back against that. How much conviction do you have that the Fed might actually have to do more and that we are seeing a head fake right now in the inflation statistics?
Well, let's look at the Fed forwards curve over the past 2 years. The market has been consistently preemptively calling for an end to rate hikes and pricing in rate cuts that have failed to come to fruition at this point. So we've seen along the past 2 years, the market consistently reminded of the old adage, don't fight the Fed. And yes, the rhetoric from the Fed has been all over the place. We've seen Fed officials say that we're at the restrictive level. Some Fed officials saying we need to remain patient, data dependent. We've also seen the chairman come out with a much more hawkish tone, pounding the table that we're not there yet. And the Fed remains committed to reinstating price stability, meaning that if we don't see further improvement in the data, the Fed is ready and willing to move forward with an additional rate hike. But I think that we're somewhat splitting hairs at this point. Whether we do see one additional rate hike or maybe the Fed is done, the notion of higher for longer, I think, is somewhat being lost on investors, despite the Fed's very clear line that they will not be willing to cut rates until we're on a meaningful, sustainable disinflationary path.
So, Lindsay, do you think that the bigger risk next year is a reacceleration rather than a recession? Do you still think that that is the underappreciated risk?
No, I think the biggest risk is a stagflation scenario. The Fed has raised rates at the fastest pace in decades, and we do expect that momentum in the underlying economy to slow meaningfully in 2024, perhaps to sub 1% on an annual basis. But at this point, if the Fed does begin to lose its resolve, we may see inflation still sticky, still elevated above that 2% level, giving us higher prices, slower growth, entering into that fearful stagflation scenario.
Lindsay, we're at a tipping point of restrictive and accommodative. And, super restrictive was Dominic Constam of Mizuno 12 months ago say. The Bloomberg Financial Conditions Index is telling me we're becoming more accommodative. It's a 0.34 number, which is actually quite stunning. Do we have a more accommodative policy right now?
Well, this is the big question. Whether or not monetary policy is as restrictive as the nominal numbers would suggest. But if, in fact, we do have a higher R-star, if, in fact, we do have other factors that are contributing to the economy that are not being accounted for in the Fed's base case model, the Fed may actually need to raise rates higher, again, against market expectations to tame inflation. If we look at the Fed's own financial volatility measure, we see that the impact from earlier Fed tightening actually peaked in December of last year. And as of December, the impact began to wane. So the idea that there's further pressure coming down the pipeline, given the current level of Fed funds, that may not be the case. And again, the Fed may be looking at the need for further rate hikes if we don't see the improvement in the underlying inflation data.
That's the fear. That's what Andrew Honhorst over at Citi's been talking about the last couple of days on this programme yesterday as well. Lindsay, we've got to leave it there. It's good to see you. Lindsay Pieg's there at Stifel. Have a happy Thanksgiving as well. I think we've got to start the happy Thanksgiving stuff, nice. Tom. Have a happy Thanksgiving. We give thanks to the Federal Reserve. The last dose of Fed speak before Thanksgiving today, Tom. After that,
is it
clean slate for the rest of the week.
They all go
clean
to their
slate.
Regional banks and all that.
And not speak.
You going with the organic bird?
The organic what?
The organic bird.
No.
No. Like $300. I mean,
we've
you
not
get some
gone there.
fancy
no, we
Park
usually
Avenue
go,
organic
No, we
beast.
usually go. We don't go for the whole beast, just the breast.
Yeah. Oh.
Yeah.
Oh. Okay.
Yeah. Don't like to have the whole
Lisa
beast,
cooks.
then you overcook it. It's going too long.
Lisa on Thanksgiving, a terror.
What's Bramo cooking?
It's just.
I am trying to bake pumpkin pie again this year. I once in college, I tried to bake a turkey, and we didn't realize it took like 7 hours.
So what did you do?
The plume of black smoke went across Lake Michigan. They could see it in Kalamazoo. What is that?
There were a group of us that were still, staying in town, and we were supposed to have Thanksgiving around 7. We ate around 11:30. Midnight, and there was a stream of people who came in.
What did happen to the pumpkin pie last year? What happened?
Well, it just blackstrap molasses don't work. So, then the taste is off, and people have to try to smother it with whipped cream, and then they just stop.
I got 2 words for Thanksgiving.
Yes.
What's that?
Jerome Schneider.
Smoked turkey.
Yes.
Pimco. Tom, you get a smoked turkey from Texas.
He sent me one of those once.
Did he? He didn't send me one.
No, the mail guys didn't deliver it to me. They said I wasn't allowed to have it, and they gave it away to charity. Which I guess is a nice thing to do with it, but yeah, at least he tried to send me a smoked turkey.
It's fabulous. I'll get the name up here for everybody. The smoked turkey is outstanding.
Trying to bribe me, TK, to say nice things about bonds or something like that.
Do you like turkey?
Sure.
Do people like it?
Yeah. It's cooked well.
It's basically a template for the sides.
Ah, is that how you see it?
I mean, it's basically like, dry.
Right, okay.
And just kind of,
We can talk about sides a little bit later. Futures on the S&P, slightly negative.
We recently, about 2 weeks ago, upgraded the U.S. tech sector again, in part because that's where we're finding quality. And there certainly is, over the longer term, this kind of big is going to do better theme that we want to play on.
That's been the theme of the year so far, expecting that theme to continue into next year. Mark Haefele there, UBS Global Wealth Management CIO. The Nasdaq 100 closing yesterday at the highest level in some 22 months and a few percentage points away from an all-time high. Microsoft at the close, record high. Nvidia at the close, record high. Equity futures this morning pulling back just a touch. We're down by 0.1%. Yields not doing much. Your 10-year 441. A couple of things to look out for this afternoon. You'll get some Fed speak in the Fed minutes. And then after that, Tom, after the close, earnings from Nvidia.
Yeah, and I'm glad you bring this up, John, and to have Mark on there with their call to leadership's going to continue here into this theme of a cumulative 2024. SPX up 45% from late 2019, early 2020.
Terrible.
You know, people, we don't have the scale. We can talk about the inflation that's killing us.
Sure.
Like you said, breakfast the other day. You used to go to breakfast, you know, you'd live large.
It's just that cafe we go
$7 tip, $42. Remember, it used to be $42 bucks. $7 tip, and it's just, it's
you go out for some
ridiculous.
eggs now. You know, you go to a diner, TK.
A diner.
It's $60
We're not talking,
two people.
you know,
Easy.
Paper
Easy.
napkin, you know.
I'm with you. Absolutely nuts.
It's nuts. And, you know, I'm looking at the NASDAQ. I mean, this is important going into Alex Webb. He only comes on if we do the NASDAQ. And the answer is, you know, it's a moonshot going out to a near record high here, again, off of that pandemic level. John, I can do this on the Bloomberg here. From the bottom here, the pandemic failure, I mean, you know, we're up 114%.
This is where people come out, Tom, and they say things like,
I don't know
the
if
easy money's been made, the easy money's been made. Nothing about this in the last few years felt easy. Yeah. Nothing about it whatsoever.
And that's where we are. We're going to get a brief right now. And as we talked to Rishi Jaluria earlier about NVIDIA and how it folds into Microsoft, let's focus on NVIDIA right now. Alex Webb is truly excellent at this. Cocktail conversation, Alex Webb. How do you identify what NVIDIA's business is?
I mean, it is a cliche. It is the picks for the gold rush, right? Everybody's been looking, whenever there's something like this, what is the company that does it? It is the AI, the chips that can, the accelerators actually, that fuel the data centers on which Microsoft, Google, AWS, Amazon are all running, are running all of the AI functions, and they are trying to sell to their end customers in the cloud. And NVIDIA is the one reaping a huge amount of the benefit of that right now.
Jensen's a superstar, but he's got 26,000 employees. How does he keep them so Nadella won't buy them like he bought OpenAI? Is it just the stock and the build-out, or is there something unique about the labor promise at NVIDIA?
I mean, it's a very poor allocation of capital to buy NVIDIA if you're Microsoft, I would hazard. You know, Microsoft can develop and is developing chips in-house that seem to be comparable to some of the things NVIDIA is doing. You'd also be, let's not even think about the antitrust implications of this. NVIDIA was unable to buy ARM ultimately for a similar consideration that would come into place if someone like Microsoft were to go for NVIDIA. The fact is, NVIDIA actually, if there's any risk to that stock in the sort of years ahead, and we're thinking maybe more in the medium term, it is the fact that Microsoft, Google, and others are developing their own chips for AI applications. And so that is where actually the Microsoft competition comes into play.
What do we know, Alex, about who's buying NVIDIA chips, about how much this is chip hoarding?
I don't think it's chip hoarding right now. Like, if anything, there is more demand than there is supply. They are trying to build out the capacity. Look, I know Tom is loath perhaps to talk about OpenAI, but like when you think about these AI products, the real money isn't necessarily going to be made in actually selling or like leasing AI services. That is actually going to be pennies on the dollar. The real money is made in the processing power to make that AI stuff work. And that processing power is sitting in the cloud. That is where Google, Microsoft, Amazon are going to be making their money. They say, hey, if you want to use OpenAI's GPT models or DALL-E, whatever, you need to be using, in Microsoft's case, Azure. If you want to be using one of Google's models, Lambda or something, then you need to be using Google Cloud. It is the kind of bait to get people onto their cloud systems, and that's when they start really, reaping the margin.
If you take a look at the profits at NVIDIA, it's been a hockey stick. And every time they steepen the hockey stick upward even more, surprising to the upside some of people's expectations. How much are we going to reach a peak at which all of the cloud operators are going to buy the chips they need? Maybe they'll have some replacements on the margins, but it won't be the moonshot that it was, and the focus will be more on the software side going forward.
I mean, there's always going to be a piece of that. So you can make the case also that the software side is pretty high margin, but there is constant innovation in this space, right? The fact that NVIDIA is leading the market now doesn't mean they're going to be leading forever, but where Microsoft and Google and others are with their own chips in a year's time, you'll expect that NVIDIA might have moved on from them. Of course, now we're getting to this sort of sub-3 nanometer process where things get even harder to eke out those final percentage points, but like it is something that is possible. I think the bigger maybe question from an equity perspective is, you know, we saw the stock hit a record yesterday. When these stocks look pretty fully valued and the market now expects a beat, like a lot of the market, a beat is a meet of expectations, if that makes any sense. And so if there's any sort of disappointment on that front, the fact that they actually, from a consensus perspective, meet expectations, then you might see a little bit of profit taking. It's not catastrophic, but that's what you see with Apple quarter after quarter.
Right. Alex, I want to drag Apple into this as well. Is Apple part of this? Like you mentioned 3 nanometer chips. Apple, I know, has a modem issue in their phone. How does Apple, in your view, watching this OpenAI soap opera?
Well, I mean, look, Microsoft, I think, right now has played a pretty strong hand. The kind of worst case scenario for Microsoft coming out of this is that actually, and this would be a short-term issue, and this will pertain to Apple in a second, but it's that Microsoft actually ends up hiring a bunch of people from OpenAI. They don't have the IP necessarily, so therefore they need a few months or maybe a few years, a year or so, to replicate kind of what OpenAI is doing. That gives Apple a little bit of leeway, but they're not competing directly in this space. Apple is doing a lot of stuff in artificial intelligence, but it's a little bit under the hood. It's the way that facial recognition happens on your iPhone, for instance. It isn't very good at the generative AI piece. It is racing to catch up. If there's a little bit of a hit on the OpenAI side, that gives them a little bit of leeway. Google is still motoring ahead in the space. Facebook, Meta, still motoring ahead in the space. So problems at OpenAI and Microsoft aren't necessarily a gift for Apple.
Alex Webb, thank you, sir, out of London, on the Saga, the soap opera, the last couple of days. Someone writes in, Locust Funds out on Twitter, just fry the beast. 45 to 55 minutes for juicy, succulent perfection. Just fry the beast. Does Alan fry the beast on Thursday?
You know, I mean, we'll have to see. Alan is at the restaurant I'm going to. It's beautifully done.
Is that so?
It's
up-and-coming chef.
Up-and-coming
Alain
chef.
Ducasse.
You know what's best about Benoit? You know, seriously?
What's that?
They have a homemade custom vermouth from somewhere in Provence I can't afford. Provence. And you go literally for the vermouth that you put in your beverage. It is
nice.
It's like a formula from like the 17th century or something.
Relatable.
I'll be having a turkey from Danielle.
Are you?
Yeah.
Oh my
Up-and-coming
word.
chef, local chef.
Local
chef.
Very
on the Upper
good.
East Side. Yeah.
Very good. And then we can go to Lisa's for
just supporting our
we
local
can go to
chefs.
Lisa's for pumpkin pie.
That's true.
Stop by, we're here.
Good luck.
Everyone should support their local chefs, Bramo.
I think I agree.
That's what they should do.
I support my father. Yeah, you could really, I really support his establishment.
I hear, but I believe anecdotally that basically they're giving away turkeys this year. That there's I believe, a glut of turkeys.
Where are they giving away turkeys?
Justin Wolfers, food
talking
expert.
about?
Justin Wolfers of Michigan, the wonderful Australian economist. We saw him in Jackson Hole. He had a thing out that the turkey dinner this year's reduced about 4%, something like that.
From last year.
From last
That's
year.
not giving it away. Cumulative. Come on.
It's
4%
cumulative.
discount for Thomas.
Well, that's true. From 2019.
Yes, exactly.
It's a cumulative beast.
I will say about frying the turkey. In Fargo, there was lots of frying the beast.
You've got thoughts?
I've got thoughts. You can't do it in New York City because it's a fire hazard.
No, you need to do it outside.
You need to do it outside. And so it is succulent and it is good.
Okay.
But you have to do it outside.
Okay.
How do you do the sides, John? You don't do Thanksgiving in England,
Going
do you?
down in flames,
No,
literally.
we don't. I
Is there an
wonder
equivalent?
why we don't.
No,
do
but is there an
Thanksgiving.
equivalent? Like, is there an equivalent where in the autumnal
Christmas.
glow you cook the eagle or whatever?
No, we do like a harvest festival, but we don't do
A harvest
Thanksgiving.
festival?
Yeah, there's a harvest
It's a pagan thing from pre-Saxon, right?
You know your history, Tom. Wonderful. Coming up, Joanne Feeney of Advisors Capital Management. She'll join us shortly, not to talk about Thanksgiving dinner. She's going to weigh in on this market. Equity futures negative by 0.15% on the S&P. Yields not doing much. Your 10-year 4.4140.
Next on the 9 o'clock hour, potatoes.
Is that the tease? with that undercuts.
Stocks are going to grind higher. We think that's a trend that's got legs.
There's still room for the market to price in further easing and even rally a bit along the curve.
There certainly is. Over the longer term, this kind of big is going to do better theme.
It's not a time necessarily to be either, aggressively on offense or defense.
We're waiting for data that will confirm one of these narratives, and you just don't have the data in yet.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
What a start to a quiet week from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market on the S&P just slightly negative. We're down 0.1%, but we are on a 5-day winning streak after the close yesterday, and NASDAQ at a 22-month high. Tom, Microsoft, all-time highs at a close yesterday. Nvidia reporting after the bow. Going into that print, we've got Nvidia at a record high at more than 240% year to date.
Arch bet for next year, and what do you do here? With Mark Hafley of UBS, we featured here today, and of course with us yesterday. He says stick with the leaders, stick with big tech and quality big tech. I guess there's going to be a debate over that, but a lot of other people are going breath. Wait, there's other people that are not in the market. They're scared stiff. But other people are going breath. That's the arch debate for me.
Massive
in terms
gains
of making
year to
money.
date, Tom. Year to date on the S&P and on the NASDAQ.
How many people participated in those massive gains?
How many people participated in the big winners? This from SocGen, stripping out the performance of the 20 AI boom stocks. Lisa, the S&P 500 would be flat.
Which is the reason why you have to wonder what has to change for this to continue. Maybe nothing, and that's what we keep hearing from everybody. But is this a boom market? It doesn't feel like one. Does this somehow remove the chance of a recession? Well, some people would say that we've had a recession in certain sectors, particularly in housing in certain areas. So at what point, how do you make sense of this with some sort of narrative? You just play ping pong.
What are we getting from the retailers? Let's talk about retailers, Bramo. I know it's a big part of your outlook this morning. Best Buy, their outlook, full year sales, -6 to -7.5. Previous range, -4.5 to -6. That stock is down 4%.
Honestly, this has not been the same kind of gangbuster positive review that we've seen from some of the tech names, some of the McDonald's and the service sector. In the retail space, you've seen disappointment after disappointment. We talked about Lowe's earlier. We could see Kohl's, a discount retailer, coming out with net sales that came in below expectations. You do see Best Buy coming in, seeing their full year comp sales below expectations, dropping as much as 7.5% compared to a low of 6% of a decline before. All of these coming out red across the board. Does this give us a forward look into the retailer, into the consumer, or is this just models that are being stressed in an otherwise stressful environment?
I think Walmart captured it perfectly. They came out, they offered you some numbers, and then they basically gave you some really negative commentary around those numbers.
Exactly.
So our forecast is not too different, but we've got some big concerns. And when they start throwing around words like deflation, you start thinking about a loss of pricing power in retail America. That got everyone's attention in the last week.
To remind people, we were on live for that. This is where the CEO of Walmart used the dreaded D word almost in an aggregate sense. And 3, 4, 5 days later, it's still being talked about in the zeitgeist.
And so then we start to wonder, is this a goods disinflation or deflation, or is this consumers not being able to spend anymore? And that's why Lowe's comment, again, echoing what we heard from Home Depot, that people aren't spending as much on do-it-yourself projects. People just aren't really going out.
Get a hotel room in
Paris.
This is the polarity of America, and you see it with these fancy tech people. The haves are rocking it. They're going to have a great Christmas. They're going to do this, do that, and there's a whole part of America flat on their slowing GDP back.
I just love how you measure things, Tom. The price of a hotel room in Paris. And then you start talking about everyday Americans in the same
Afterthoughts teacher
sentence.
conference last night. I walked into the French teacher and said, "What about hotel rooms in Paris?" And she starts off on the hotel rooms in Paris.
I want one more name in the mix if we can. Dick's Sporting Goods up nicely in the pre-market. Let's get the name on screen if we can. The numbers, the outlook for full-year adjusted EPS, Lisa, here's the range, $12 to $12.60. They had seen $11.50 to $12.30, so a bit better than expected there.
In fairness, though, remember last earnings period?
It was terrible, which speaks to the move. We're up 11%.
But this is sort of where we are in terms of expectations versus deliverance. The fact that they came out and they beat expectations was an incredible win compared to the debauchery that they announced last time around.
Just want to push forward to one more event that could be taking place a little bit later. We'll be speaking to Anne-Marie right here in New York in about 10 minutes' time. This from Axios. just pushing the story forward just a little bit. A deal between Israel and Hamas to free dozens of hostages and declare a multi-day ceasefire is imminent and could be announced by the Qatari mediators as soon as today. This is reporting from Axios. Two sources with direct knowledge of the issue speaking, Tom, to that particular outlet.
Yeah, I'm so glad you bring this up, and I will lead with this in the first question to Anne-Marie Horton, because this is off the radar. How can this dare be off the radar? If these are hostages in a war zone with crushing visibility, and we're talking about OpenAI.
And it's the potential for a cessation of violence at a time where we see people being crushed, people being killed, people's families being destroyed. I mean, this is a horrible situation, and anything that could potentially alleviate it is welcome news.
Couldn't agree more, Bramo. Couldn't agree more.
Anyway, let's talk about what we're looking at today. We are talking about earnings. We're going to be following the story in the Middle East. 2 p.m. we get Fed meeting minutes from the October 31st, November 1st meeting. I care very much. I think it's going to be fascinating, talking about maybe pushing back against some of the rate cuts getting priced in. And after the bell, NVIDIA earnings. Honestly, again, it's how much of a beat do they have to deliver for the shares to keep being a moonshot?
Lisa, thank you. NVIDIA, after the close. Let's talk about that now. Joanne Feeney, partner and portfolio manager at Advisors Capital Management. Joanne, Lisa talking about NVIDIA after the close, the dominance of big tech so far year to date. Our conversation this morning, Joanne, do you believe that can continue, not just into year end, but beyond into 2024?
Yeah, good morning, John. I don't think we should expect in 2024 anything like what we've seen in 2023. And remember that 2023 was a bit of a recovery off of a really tough 2022 when we saw earnings expectations start to come down. Of course, interest rates up, reducing those valuations. So you have to put 2023 in the context of what happened before. And also, of course, we have built in, which is all in the news right now, the AI discovery in some sense by the general public and the general investing public. And that started a year ago, and it's really played into a lot of these stocks. We're not going to see that happen again.
Joanne, what do you do with portfolio construction here? Do you de-diversify and own fewer things, or do you spread it out? Do you play for breadth? Or what do you do with your underweight ownership of Microsoft? What's the strategy for next year?
Yeah, Tom, this is an interesting time of year, first of all, because clients are asking us, what they should be doing in terms of their taxes. We get a lot of calls about the realized gains they've experienced, and a lot of clients, or a lot of investors, will have experienced gains this year because of the run-up in such a small number of stocks. So that narrowness of the market created problems, because if you didn't want to become too overweight, as you put it, Tom, get too narrow and concentrated because of those, Magnificent Seven, you will have had to trim those all year long. And so you've created a lot of realized gains. So now the thing to do is look at your losers and make a lemonade out of those lemons, and realize you can get something out of them by selling them for tax losses, staying out for 31 days and then getting back in. But you have to be really careful how you do that, because you're going to be out of some stocks. And that defers, Tom, your question about diversification. We can go into that if you'd like also.
Well, but Joanne, just to sort of underscore what you just said, are you saying basically the losers are going to lose even more heading into year end because there'll be a tax loss and a benefit there, and the winners can keep gaining?
That's Lisa, that's like massively trying to time the market. It's really hard to do, right? It certainly has been the case in the past that some losers have continued to lose into the end of the year as investors do tax loss harvesting sales. We've seen that before. It's not terribly predictable, but it does tend to happen. It's hard, though, to pick a stock and say, oh, I know this one's going to continue to go down. Let me get out of it. It isn't so much that. It's that you just want to be aware of any positive catalyst that might be on the horizon. Is there an earnings report coming up that you feel good about, that you have data on that suggests it's going to be a beat? You don't want to be out of that stock. And in the meantime, what you can do, though, if you're tax loss harvesting something in consumer or in industrials or healthcare, is you can get out of that stock for 31 days and put that cash in something that has similar exposure, whether it's an ETF temporarily, whether it's another stock. So you just want to be aware of what you're getting out of, and then make sure you cover yourself for that exposure that you still want to have.
When we look forward to next year, a lot of people are debating what the bigger risk is, a real consistency to the economic expansion that we've seen, or some sort of recession, a harder landing than is expected. And we're looking at some of these retail earnings that are coming out this morning, and they're underwhelming by and large. There are a couple of exceptions, but really projecting out greater weakness than people were previously expecting. How much of a signal is that in a broader macro sense versus noise around these specific retailers?
Yeah, it's going to be both, Lisa, right? I mean, we saw some of the earlier consumer stocks do well and signal, okay, consumers are still spending, retail sales, not so bad. But then you contrast a Dick's with a Best Buy and you recognize that it just depends. What are you selling? So it's a bit hard to predict. What we have found at this time is it's useful to take those winnings that you've had in some of the big seven, the Super Seven, and use them to diversify, because other stocks are a real bargain. You look at 493 of those 500 S&P names, and you'll find a lot of value there. So this is actually a good opportunity to take advantage and diversify. And to the question of whether we're seeing more consumer weakness, we could very well be, and we should expect to see some weakening go on there after this period of strength with the high inflation, with the drawdown of savings.
Join Feene very quickly. And folks, you've got to understand on Bloomberg Radio, Feene with a 4-screen Bloomberg in the background over her right shoulder. Join Feene, when you're using the Bloomberg, what's it say about the banks then? If I'm going to sell Microsoft to buy the banks, which banks?
Well, we like several different banks. It depends what you need, again, to round out your portfolio. Some of the big money center banks like a Citi or a JP Morgan, we like both of those. But we also like some of the smaller financials outside of the big money center banks. They got beat up during the financial crisis and they still are beat up. So there are opportunities there. You have to be willing potentially, though, to ride out a recession, because that risk is not off the table, even though it's considerably lower than it once was.
Joanne, thanks for the update. Joanne Feene there of Advisors Capital Management, pushing ahead to two key events a little bit later. We've got NVIDIA earnings after the close. That stock, Tom, you would say a moonshot year to date, up by more than 240%. And every time we raise the bar for that company, TK, they appear to knock it out of the park every quarter.
Well, they do, and it's on on a revenue basis on unit and price. They've got huge price persistency. Everybody wants their product because there's not many competitors. Is it a monopoly? I'll let smart people tell me. I don't know, but the unit growth is just scary.
I have to say,
Saudi Arabia, and you're buying NVIDIA chips in your blue boxes around your tree.
Fed minutes feels like a bit of a snooze today. Don't you agree?
It's every Fed.
It's just not being discussed, Ramo, in quite the same way. It just feels like a lot of people are just parking this, putting it to one side.
Okay, the idea is that they can massage the minutes to say the message that they want to put out there. Do they really want to send a message? Or they just find this is orchestrated confusion, deliberate confusion? They don't know. You don't know.
Proceed carefully.
Let's go see what happens.
You know what they're going to have in the minutes?
Yeah, exactly.
Get to Thanksgiving.
Some
things safe when you put that turkey into the fry.
Exactly.
All of that stuff.
A few will have dark meat.
Thank you, TK. That's helpful. If you're just joining us, welcome to the program. The S&P 500 looks like this. We're negative 0.1%. Yield to going nowhere, 441.59. I gave you an update on the latest, the situation between Israel and Hamas from Axios. CNN also matching that, reporting that the Israel-Hamas deal on 50 hostages could be announced today. This, according to Axios, is a two-phase deal. I'll share with you the first phase of this. Lisa, Hamas expected to release 50 Israeli women and children held in Gaza, while Israel is expected to release around 150 Palestinian prisoners, mostly women and minors. As a part of the deal, Israel would allow around 300 aid trucks per day to enter Gaza from Egypt. There's a lot more detail to the second phase as well, but this could be announced as soon as today.
And we're hearing this from the Hamas leadership, which is actually interesting. They've come out and been much more vocal that they are close to a deal, and we've been hearing about this moderated by Qatar, and the U.S. is involved and has certain negotiating tools as well. Does this mean that we could be ending some sort of resolution, or is this just basically a softening the ties? Either way, we don't know, but we do know that if there can be violence stopped, and hostages return, that would be a wonderful thing.
It sounds like progress. It's a developing story we'll keep one eye on. Anne-Marie, lucky to have her with us. She's here in New York City. We'll get the latest from AMH in just a moment. Equity futures just negative by 0.1% from New York City. Good morning.
If you're going to secure the release of hostages, and we certainly hope we're going to be able to do that soon, you got to make sure they can get from where they are to safety, and do that as safely as possible, which means you're going to have at least a temporary localized stop in the fighting. to allow them to move. I mean, we also can't take for granted that all these people are easily mobile and don't have some sort of health issues that require perhaps a slower route out or assistance getting out. So I don't want to negotiate in public, but we believe we're getting closer.
We believe we're getting closer. That was John Kirby, the National Security Council coordinator, delivering a briefing at the White House just yesterday. The latest reporting, led by Axios this morning, that a deal between Israel and Hamas to free dozens of hostages and declare a multi-day ceasefire is said to be imminent. We'll pick up on that reporting in just a moment. If you're just joining us, welcome. The state of play, the scores in financial markets look like this. Equity futures pulling back by 0.1% on the S&P. Yields going absolutely nowhere. 441.20 on a US 10-year. Two events on the schedule, on the calendar a little bit later. After the close, you'll hear from NVIDIA. We get earnings from them. Tom, a little bit later this afternoon, minutes from the Federal Reserve. But front and centre for us has got to be the prospect of hostages being released out of Gaza by Hamas.
There's no question about it. This is a developing story, and we're thrilled. Joining us, our Bloomberg Washington correspondent, Anne-Marie Horton. Anne-Marie, how many hostages are there, do we know?
There's about 240 that were taken, but this deal would only encompass about 50 to 100. Potentially as high as 100. Likely they'll start in a lower number. I have reporting on this as well that matches Axios. It'll be over the course of a few days, and it'll also mean that there will be Palestinian women and children in Israeli jails that will also be freed. It will also allow for more humanitarian aid trucks to enter Gaza. We have been here before, it's one of these things that it's really difficult to talk about hostages when you're close to a deal because you don't want to give their families false hope. So it's very challenging. But the fact that Ismail Haniyeh, the head of Hamas in Doha, came out today on Telegram and said we're very close to this, quote, truce, says to me that we are potentially at the end of this negotiation.
So we understand from reporting this morning there's two phases to this. What are your sources telling you about that, phase one and phase two?
Well, of course, for Hamas, the leverage is the fact that they have these individuals that Israel, that Argentina, that the United States want to see free. The phase would be a pause in fighting. They would allow some of these hostages to be let go. The Israelis need to let go of some of these Palestinian women and children that are in Israeli jails. They also need to allow more humanitarian aid trucks. So it's very complex, this negotiation. And it's why I think we should say that no deal has yet happened. No one is announcing a deal yet, but we are very close. But John Kirby yesterday, Admiral Kirby, said this is the closest we've ever been.
Do we have a sense of what the sticking points were? Because they've been pretty close for a number of days now.
I think one of the biggest sticking points is the fact that Israel has said there will be no ceasefire, no pause until Hamas is destroyed. But Israel has come under immense international pressure because of an incredibly rising death toll in Gaza, more than 12,000 individuals. One agency has it at 1 in every 10 Palestinian children have now died that are living in Gaza. So Israel has come under immense pressure. Hamas wanted to see a pause. They wanted Palestinian women and children back. And I think really the pressure has come under Benjamin Netanyahu to strike this deal to get these hostages out.
What does it mean in terms of the progression of this war and what happens next? Does this mean that this is the beginning of ongoing negotiations between Hamas and Israel, brokered by Qatar and the United States and United Arab Emirates? Or is this just what it sounds like, a pause to achieve the goals that you just laying out?
I think it's unknown at this moment. I think what we do know is that this would be a pause. I don't think you see Israel coming out and saying they want to have a ceasefire. Everything they've talked about has been about hostages, very close to getting hostages out. Potentially, though, it sets up the parameters to have a wider conversation about winding down and the end of this war. We do know that Israel obviously has gone into what they call the center of Hamas and their infrastructure in Gaza. But we also know they are moving south, which is where they actually told Palestinians to flee for safety.
To Lisa's point, has anyone articulated an endgame here at all?
People have pontificated about an endgame. They've talked about what an endgame could look like, but not everyone agrees. This is a very challenging moment. Israel has said that they want to maintain the security control of Gaza after, so they don't have another attack. You have many in the Arab world saying Israel cannot reoccupy Gaza. Israel doesn't want to reoccupy Gaza, but who then controls Gaza? right? It's very challenging because the Palestinian Authority controls the West Bank, but we're talking about an 87-year-old leader, Mahmoud Abbas, that doesn't have a successor. Any successor that there has been over the course of a few years, he has really tamped down their potential stride above him. So it's a challenging moment. People talk about maybe a coalition of Arab states coming in, but we're not there yet.
We're not there yet. Let's talk about what this could mean for the US president going into next year for Joe Biden. We've noticed in many polls he's not doing well. There's a very specific demographic where he's really not doing well. And it seems like all roads lead towards foreign policy at the moment. Is that right?
When you're talking about the youth, they are very unhappy with this White House. More than 70% of the youth in this latest NBC News poll over the weekend are unhappy and do not think he is handling the Israel-Hamas war correctly.
This is really important. Britney Spears is 39 and holding. Taylor Swift is 33, and this guy can't figure out who Britney Swift is. When does this end? I mean, come on, this is just basic stuff. He's screwing up Britney Swift. You can't do that. I mean, these two are icons, earned icons.
True, and one had a hit when I was 10 years old. In 1999, I had the CD.
Oh, come on.
The whole thing.
The day that Taylor Swift came out with Def Leppard, she was like, what, John, 16 or whatever? She's with the lads from Sheffield. She came out, and it's like, who is this person? I mean, she was ginormous then, and she's gotten even bigger. And the President of the United States is conflating Britney and Swift.
For some members of the youth, I think this would be an egregious mistake. I understand what you're talking about. And, you know, it's quite concerning.
She can say that with a straight
face.
It's
quite concerning for the president who says he calls his grandkids every single day. Clearly they know who Taylor Swift is. But yeah, he had a gaffe yesterday when he was partying the turkeys. By the way, surveillance correction, Tom. It is not the Hay Adams. It's the Willard Hotel.
I got a phone call from the Hay Adams. We would never let the beasts in.
But yeah, he said Britney Spears is on tour somewhere hot. He clearly meant Taylor Swift, who's having an incredible tour that's sold out basically everywhere. So he's not doing well with the youth vote. And, you know, yesterday, Rick Davis and Jeannie Chan Zeno on Balance of Power were arguing about this.
Arguing about it.
Yeah, Rick doesn't think that the youth vote, he says they always stay home, but they came out and drove Biden in 2020. And when you're dealing with really small margins in swing states, it's important that they go out and vote and don't stay home.
You know what the issue is here? How many people over the age of 80 know who Taylor Swift is?
Everyone.
Compared to the younger cohort. Come on. What this is about is every mistake this president makes now is going to be attributed to his age. That's what he's up against. That's what this is about. Without a doubt. It's the reason, Tom, you brought it up. If anyone else made that mistake, we wouldn't even be talking about it.
This is critical, though. Reagan got old. Bush Sr. got old. Forget about Woodrow Wilson, ancient history. Why is this guy different? Why is Joe Biden? It's because he's running again. He has the audacity to run at this age, whatever anybody's politics is. That's really what this is about.
He's running again, and there are individuals within the Democratic Party. The Washington Post has a story out this morning how, quote, donors and those part of the campaign are, quote, wetting the bed. That was the quote one of the donors said to the Washington Post.
Can we say that on here?
Because they are concerned. I know, I'm breaking a lot of rules this week. They are concerned about his age and how this would look if he runs for re-election and is a one-time president and loses to Trump.
Based on certain events we've seen over the last year, they're right to be concerned.
Well, what stood out for me from this NBC poll is not so much how bad Biden was doing, but how obvious it is the American people want a different choice. When you look at a generic Republican against Biden, the generic Republican wins. When you look at a generic Democrat against Trump, the generic Democrat wins. The American people don't want to see either of these men. They are politically married.
And this is all we're seeing. AMH, thank you. It's great to have you with us in New York. I want to turn to stocks. Bank of America, Savita Subramaniam, out with a year-end forecast for next year on the S&P 500 of 5,000. 10% upside from here. So we'll talk about the reason why
onward
in just a moment. Equity futures negative 0.1% on the S&P. Yields going absolutely nowhere. Your 10-year 4.41 from New York City. This is Bloomberg. The Nasdaq 100, 22-month highs coming into Tuesday. The price action, the scores look like this. Equity futures pulling back just a touch on the Nasdaq. We're down 0.1%. We're down 0.1% as well on the S&P 500. The S&P through yesterday on a 5-day winning streak. In the bond market, we are shaping up as follows. Your 2-year, 10-year, 30-year looks a little something like this. We're down a basis point on a 10-year, 440, 62. 30-year, down 2 basis points, 454, 55. Two events we need to talk about. One, Nvidia. Two, Fed minutes. Let's go to the Fed. This from Bank of America. The team led by Savita Subramanian. The year-end price target for next year, 5,000. So 10% upside from here. Love this line on the Fed, Bramo. We're bullish not because we expect the Fed to cut, but because of what the Fed has accomplished. A different way of framing things over at B of A.
Which actually feeds into what we heard from Margaret Patel and others, that essentially we're not going to necessarily get the recession that many people expected. They are going to achieve a disinflation that will continue. And it's not going to be whether rates go materially lower. It is that this economy can maintain the strength that we've seen.
I'm fascinated what Savita says. She does great analytical work. She takes an Excel spreadsheet like nobody out there. And I'm fascinated, John, how you get to 5,000 with breadth, with sector dynamics, with which ones will lag energy banks, whatever the consensus is, but particularly what Savita and Bank of America think about those leadership stocks.
Like Nvidia. You could just own Nvidia. Year to date, the name
It's not the way it works,
looks
John.
like this. If only, TK. If only. Up by 245% year to date on Nvidia, Tom. Earnings after the close.
And I'm going to say this, and Savita's going to laugh at me, a cumulative 2024. Let's remember that Savita was pretty cautious there X number of months ago, and then she had the courage to adjust where many others didn't. She got more optimistic, but now she steps up on the edge of Yardeni. And that's some of the, it's like that's one narrative from one big bank. But what are all these people of all different shades going to say? What do the bulls do? Does Binky Chadha pull back at Deutsche Bank and say, okay, I've been so right, I'm sick, I'm going to calm it down? I don't know.
The dominance of these names, just phenomenal. Just phenomenal once again. Big debate going into next year, whether that continues or not. Let's get you some news. Under surveillance this morning, OpenAI saying the company is in intense discussions to unite staff after the ouster of CEO Sam Altman. A majority of the company's employees threatening to quit if Altman is not brought back. The Microsoft CEO, Satya Nadella, Altman's new employer, telling Bloomberg's Emily Chang he was unaware of any issues.
I've not been told about anything. They published internally at OpenAI that there is not the board has not talked about anything that Sam did other than some breakdown in communications. And I've not directly was told by anyone from their board about any issues. And so therefore, I remain confident in Sam and his leadership and capability. And that's why we want to welcome him to Microsoft.
So welcome him to Microsoft and maybe send him baback to OpenAI.
Basically, this was Satya Nadella saying, heads we win, tails you lose, because either way, we're going to win. Either way, they have 50% or 49% of the investment in OpenAI, so they want to preserve that. On the flip side, if they have their own AI unit internally without having to purchase OpenAI, that's great too. Either way, there is a clear breakdown in understanding. We still don't know what happened. We still don't know why the board made this move that might cause this palace intrigue of just insane proportions
sure.
that everyone's been talking about.
Let's be blunt about it.
Please.
We're talking about one of the best leaders on the S&P 500, maybe even the best CEO, Tom, on the S&P 500. I think it's fair to say this is not how he does business, given the events of the last few days.
Yeah, absolutely. It's not. And, you seize the moment, and that's certainly what Microsoft is done here. And I'm sorry, on a game theory, I'm talking like Mohammed here, on a game theory basis, everybody else has to respond. How does Amazon respond? How does Google, particularly Google, how do they
trying
respond?
To get some of those
Mark
stuff
Benioff,
too.
you mentioned earlier, Mandolin Collector. You wonder how Benioff, reacts to this and the rest. It's going to be a feeding frenzy. Can you imagine a latte shops out there now?
Mandolin Collector.
Mark is one of America's great. Benioff is he's collecting the heritage of American mandolins. I mentioned J.D. Crowe in the South the other day. Benioff's all over somebody like J.D. Crowe in the South.
Do you have one of those things? Tom Hanks, I think, collects typewriters. Do you have random things you collect?
Yeah.
What do you collect?
Divorces.
Maybe we should leave that there, just in case Mrs. Keene is watching this morning. Let's turn to Citi, cutting 300 senior managers or 10% of staff at that level in an effort to simplify the bank. Bloomberg reporting the cut started yesterday, with more expected in the coming year. The restructuring is set to be the biggest in 2 decades and reduces the focus to 5 businesses. Let's go through them. Trading and banking, services, wealth management, and Tom, U.S. consumer offerings.
It is, and it's, Chanel and others are talking this up, and some names are starting to come out in trading. 10-year track record, Citigroup, a negative 1% per year has been the annualized return. It is urgent. Jane Fraser, without question, is doing work Mr. Corbett should have done 6, 7, 8 years ago.
And she's trying to move faster, trying to go a little bit more quickly. Final story for you. The minutes from the Fed's latest meeting coming at 2 p.m. this afternoon, 2 p.m. Eastern time. Investors looking for insight into Chair Powell's dovish comments despite strong economic data. The Fed's next rate decision due December 13th. Financial conditions have eased. Yields are lower. And all we've heard from them so far, Bramo, even with a 50 basis point move on a 10-year in a single month, is we will proceed carefully.
They have no incentive to come out and say anything.
Zero.
And so basically they can pack it in. They've got no expectations for December 13th. They can just basically say, look, guys, you're on your own. Figure it out because we're done. And that seems to be the message. So now people have to debate what the trajectory of the economy is and how much work they've already done.
December 8th, we've actually got a survey statistic. I don't know how good it is this far out, 175,000. But what he needs desperately is a more tepid jobs report, a late report towards that Fed meeting.
Jobless claims the one to watch, I think, this week. Just in terms of the economic data.
Drew Mattis is all over that.
Ditto.
Mattis at UBS, he was like 23 years old, screaming it's weekly data, look at it.
And I get it. Look, we're coming off exceptionally low levels. I understand all of that. Even at current levels, still exceptionally low. But the change, Tom, is worth looking at. We just started to creep higher over the last few weeks.
Right now on fixed income, Michael Collins joins Senior Portfolio Manager, PGIM Fixed Income. Michael, what is the symbolism of the inflation-adjusted 10-year yield coming in and in? I got a 2.09% print this morning. That's extraordinary. What does that mean for our viewers, our listeners?
Well, as you know, the world's discount rate, the U.S. Real yield is what's driving valuations on everything in the world. And that real yield, Tom, at 2.1 or so is probably still 100 basis points too high, right? I think it's supposed to be somewhere between 0 and 2. So I think there's still room to go there. I think if you believe the real yield should be above 2 permanently, remember it was at 2.5 just a few weeks ago, you're buying into the notion that we're going to have this continuation of really strong real growth in the U.S. and around the world. And it feels like that's not in the cards.
What is your x-axis to get even halfway there? That's a bold statement by you that the inflation-adjusted yield 2.50 down to 2.10, and it will, I'm going to use this word carefully, Michael, plunge lower. What's your timeline to make that happen?
These things tend to happen more quickly than the markets price in, right? I mean, just a few weeks ago, the markets were pricing in a funds rate that ended at 4.5% and never got lower than that over the next 10 years. And now that number is 4, right? So the markets are pricing in kind of a permanent funds rate at 4. And again, that probably is 100 or maybe 200 basis points too high as well. And we do know when the Fed is done, and the Fed is done, that's why the minutes today don't matter. When they're done, rates rally, right? That's the beginning of the rally in the bond market. As soon as the message is clear that the hiking cycle is over, because the markets always overshoot on the upside and then they overshoot on the downside. So I think we just hit the overshoot at a 5% 10-year, at a 2.5% real yield. And now we're probably on the way down. I mean, rates today maybe look fair value in a good world. But, we've had disinflation, as you've all talked about this morning, and it's been driven almost solely by the supply side, the huge rebound in the supply side, both from the labor market and the productivity boost. And I worry that 2024 is going to be a demand side story. And that's the bad disinflation, right, that we're worried about. And if that plays out, if inflation ends up having 1 handles instead of 3 handles, which is very possible, and we're kind of moving in that direction pretty quickly now, who knows? Rates could be offsized by quite a bit.
That's the worry of equity investors as well, Mike. Let's talk about bigger picture. And I'll do this for you because you're far too modest. About 10 years ago, you and a team, I'm thinking Robert Tipp, Greg Peters, were really known for this call of low interest rates, low inflation, range-bound yields, low and range-bound. I remember the phrase. It was the low ranger. Now, Mike, that was 10 years ago. You guys won awards for all of that. We celebrated them on this program. A decade later, post-pandemic, can you talk to us about this regime and how different you think it will be?
I mean, certainly you're in a world right now, Jonathan, where you're seeing a kind of generational high in capital investment in this country in technology-related things. You've been talking about AI all morning, right? And it's happening, and it's real, and it's increased our productivity in this country significantly over the last year. And there's a chance that is sustainable, that this AI and the robotics and all of the technology investment does lead to more sustainably and higher real GDP in this country. Let's say in the 2s as opposed to in the 1s. And that's a big difference. And there's also a chance that inflation, doesn't fall back to 1.5, that it gets stuck at 2.5 or 3. And I think geopolitics and climate-related risks and energy transition and shortages of labor around the world are all factors that could lead to stickier inflation. So yeah, there's this big high probability scenario out there that, that heck, maybe, like I said, rates are fair value here, that the funds rate bounces between 3 and 5 for the next 10 years, and the 10-year bounces between 3.5 and 5.5, and maybe you're in the middle of that range now. So that's a scenario that we're really contemplating very seriously as a pretty high probability. But of course, you do have to be humble in this business, and that downside risk is always out there lurking and looming. So it's something we're certainly looking at.
Have you gotten more conviction over the past 4 weeks, Michael, as the market seems to be accepting the idea of possibly more aggressive rate cuts next year?
More conviction on rates, maybe a little bit more. I think the inflation side is really what's given us more encouragement. The disinflation story seems to be kind of embedded now, and we're not as worried about a permanently higher, inflationary environment, right? So that's really a big delta that we're seeing recently, with goods prices in deflation right now, right? And services inflation is finally coming down. So, and the labor market is seeing some cracks, right? Which leads to lower wages. So all those things give us encouragement on inflation, which give us encouragement that, hey, maybe we've seen the high in rates, and who knows, maybe the next move is 50 basis points lower instead of 50 basis points higher. On the credit side, though, the markets have run with this low inflation, soft landing world, and and the equity market too, right? So risk assets have rallied hard just in the last few weeks. And I think you're supposed to be really careful there and fade those rallies.
Feels like a much tougher call on the credit side. Mike, thank you, sir. It's good to catch up with you. Mike Collins there of PGIM Fixed Income. If you're just joining us, welcome. Equities look like this. Big day a little bit later after the closing video coming up. Futures negative by 0.14%. Outside of NVIDIA, also got these Fed minutes. This from Andrew Honhorst of Citi, publishing just moments ago. In theory, these minutes could push back against looser financial conditions, but here's the but. We doubt they will, as officials have responded asymmetrically, Lisa, to tighter as opposed to looser conditions.
The idea that maybe they're more preconditioned to wanting to see rates go lower because they are concerned about the weakness, right? This is the suspicion in markets, that they actually see greater weakness because of anecdotes that they listen to, because of some of the fast-moving unemployment claims and things of that nature. And so they're not going to push back, even though there has been a material loosening in financial conditions.
I feel strongly that they're massively data dependent, and it seems like labor is a distinction. Witness the Morgan Stanley Goldman Sachs debate of 10 days ago. They're going to wait for the December jobs report, the November report, rather, December 8th. And that will be a key determinant on what right now is a snooze fest. Maybe it won't be. Maybe December 13th.
What a change, though, the fact that we're talking about the Federal Reserve and snooze fest in the same breath.
Well,
after what we've seen over the last 18 months. That's
mission accomplished.
You want to go that far?
No, I'm not going to.
Yeah, exactly.
Importantly, no one has said that.
But, they don't either. Yeah. That's for sure. Equity futures on the S&P negative by 0.15%. Live from New York City. This is Bloomberg.
The single biggest thing you can point to is what's different in goods inflation, and I think that's what we're all not looking at enough right now. because we've had a big disinflation in goods. So I think it's easy to kind of look at that and say, well, we've kind of returned to this pre-pandemic goods deflation. And that's what we had pre-pandemic. Goods prices went down over time. And I think anyone who's been out buying things over the last couple of years, certainly the experience is not that goods prices are down.
Andrew Hohenhorst, the city, just absolutely brilliant a little bit earlier this week around the table from New York City. Welcome to the program. Equity futures on the S&P 500, negative 0.15%. A good morning to you all from New York. Going into an interesting day. It starts this afternoon, really, with Fed minutes, then picks up after the close. Funny enough, when we get NVIDIA earnings, Tom, that's the main event a little bit later.
It's the main event, and it's a raging debate about leadership, John. Let's say they stumble. I mean, I'm predicting it. But let's say, in some way that I don't understand, NVIDIA stumbles. I mean, what does that do to 40 multiple stocks
hurts them,
in the
I think, is
the
easy answer. I mentioned this stat earlier, Tom, from SocGen. I think this is really interesting that if you strip out the performance of the 20 AI boom stocks, you've got an S&P 500 that would be flat. That's where the gains have come from, that euphoria. We spend a lot of time talking about the Federal Reserve, the cycle, the economic data, payrolls, all of that stuff. An AI frenzy behind some of these moves, and a legitimate one based on some of the numbers we've seen from NVIDIA.
And we don't talk, I'm as guilty of this as anyone, we don't talk about the laggards. I'm going to suggest energy and banks are part of that flatness in the unweighted stocks.
Which is the reason why I almost joke, if NVIDIA misses, does the Fed cut rates by 100 basis points? Because all of a sudden, the idea of the sort of enthusiasm around the American economy gets
they got to
deflated.
love that. I mean, Alan Greenspan would say the market has a clear indication on the goodwill of the American economy. We're getting that right now. Dow 35,000, SPX. John, are we going to get 4,600? On SPX, we're talking doom and gloom 3,500.
We're getting 5K year end next year, according to Bank of America. As you mentioned.
I mean, these are huge moves. And I'm sorry, the equity markets matter for Jerome Powell. That's Greenspan 101.
Yeah, in which way? In what way? Is this what Andrew Hohenhorst is getting at?
President Trump would say a tone, constructive
12 months ago, they wanted tighter financial conditions, and then we got some pushback when we started to see yields breach 5%. A 2-year at 5.25.
Well, that was
but maybe that could do some of the work for them. Then you start to see that move unravel. I don't get pushback the other way, which is essentially what Andrew's saying here, Lisa, that they respond to this asymmetrically, or at least have done over the last month.
This is why I struggle with data dependency and that whole concept. Which data? Are they looking at the market? How are they looking at the market? Are they going to focus on an employment cost index this month? Are they going to focus on JOLTS? Are they going to focus on the University of Michigan sentiment survey? It's the one that stands out at that moment. So it's very difficult to really form a cohesive opinion about this.
You got Savita at 5,000. The wonderful interview we just had with PGIM, if you get their framework on real rates, that turns all of this blah, blah, blah on its head.
A lot to unpack with PGIM.
Yeah.
I actually thought the more interesting point there, Tom, was that they have more confidence that yields are going lower for a bunch of reasons. If yields start going lower, not because of disinflation, but because demand is collapsing, that complicates the credit call.
That's the ambiguity.
So the credit call for them can go two ways. If you're getting lower yields, you're getting disinflation, but you're also getting weaker demand, then it complicates the credit call.
Secondary, I agree, secondary, but then the housing market maybe gets an act of God nationwide, because rents nationwide are not like in New York.
Do you really think it greases the wheels? You come down from the 7s into the 6s?
Don't know. We've never
rates.
seen this. Don't know. Bramo's looking at 6 bedrooms. And
should we ask someone who might know?
Drew Redding with us right now, expert on this. Drew Redding is the man on Home Depot, Lowe's, and the rest of the home builders for Bloomberg Intelligence. Drew, let me start with a basic idea that Home Depot trades at a premium to Lowe's. Call it a PE compare of 19 versus 15. Why are they second best to Home Depot?
Yeah, good question. And interestingly enough, the premium of Home Depot over Lowe's is at the highest level it's been in some time. A lot of that has to do with the greater productivity in the Home Depot stores. Lowe's has kind of lagged in that regard. In addition, Home Depot's growth has traditionally outpaced Lowe's, and a lot of that has to do with their exposure to the professional customer, which typically higher spending, and they drive greater store productivity. So that has a lot to do with it.
Either way, there was a cohesive message from both of these companies that big ticket items are on the decline in terms of purchases. We heard this from Lowe's today, that they're seeing lower than expected do-it-yourself sales. Is this a macro call or a micro call? Is this a representation of a housing market that's in stasis, or is this a broader pullback in spending that you see in other facets as well?
So I think there's a couple things going on. First and foremost, I do think that the consumer is under greater pressure than we've seen over the last several quarters. And as you mentioned, it's the pullback in discretionary items. So, think of things like floor and cabinetry, appliances. And, another big piece of this is think about how much Lowe's grew sales during the pandemic. They grew sales about 30% during a 3-year period, so about 16% annualized. And that compares about 5%, in any given year. So we think there's a lot of pull forward demand during the pandemic, and we're starting to see some of that give back. And then, the last thing you have to mention is what's happening in the housing market. We have sales of existing homes that are below, the 4 million annualized rate. It's the lowest in over a decade. So while that traditional relationship between home improvement spending and sales isn't as strong as it used to be, you'd be naive to think that with sales as low as they are, that's not impacting the story.
So let's go there. John and Tom were discussing this just a minute ago, just how far lower would mortgage rates have to go to ignite some actual action in the home sales market. What's your sense? How far do they have to go?
Yeah, I mean, it's obviously a tough question to answer. And as Tom said, we've never been here before. But, if we look at what the builders have been saying, it seems like something in that 5.5% rate has spurred some additional activity. Now, the home builders have been able to get there through rate buy downs, but it's the broader resale market, which has traditionally been about 90% of total home sales, which is struggling. So I think, if we get into that 5.5% rate, I think that starts to spur a little bit more activity. But, right now we're just coming off 8%. And we're looking at something about, 7.25, 7.5 at this point.
Drew, can they do what they did the last 10 years? I mean, even Lowe's, which we perceive as a laggard to Home Depot, has done 17% per year, rough 16, 17% per year total return. Do you frame out 10 years out as a redo of that, or is there a lower expectation?
Yeah, so we're typically looking out over the next handful of years, particularly in this environment. So we do think that consensus calling for a return to growth next year is probably overly optimistic. I think consensus is calling for low single digits. We think something in a low single digit decline is probably more likely. But when we get on the other side of this slowdown we're seeing in the broader housing market, we think that the market can, return to growth in kind of that low to mid single digit range. And a lot of that has to do with, the opportunities that are out there for Lowe's in terms of their investments in the pro market, their investments in their e-commerce platform and their supply chain. So, we do think that there's a bit of pressure now and headed into next year, but beyond that, we do think we'll see more normalized growth.
Hey, Drew, thank you. Drew Redding there of Bloomberg Intelligence. We've gone through a bunch of surprises year to date on the S&P 500, given what we've seen happen with yields, interest rates, and the Federal Reserve. To see PulteGroup, the number 4 performing stock on the S&P 500, Tom, up 94%.
I missed this.
Mortgage rates at 7 plus whatever it was only a month ago. And we've seen PulteGroup up 94%. It's a story a lot of people miss, TK, that people wouldn't be selling their homes because they were sitting on 2 to 3% mortgages. And these home builders would be the guys that were just selling houses to places where there just weren't homes on the market.
I have no interest in NVIDIA, but I can say that I framed out that big tech would do well. I did not frame out that housing would do well. I completely missed it.
It also highlights how rate insensitive the market has actually been in the economy, because a lot of these developers have been able to offer financing at a much lower rate than the headline mortgage rates that people are able to get elsewhere. So, again, it goes into this question, how long and variable are the lags? Have we really felt the tightening if housing market has just basically died in the resale market and the new housing market has a much lower figure in terms of financing costs attached to it?
Those lags are 20 years long.
Exactly.
30 years long.
30 years.
Based on the effective mortgage rate, last time I looked at it on the Bloomberg, it was something like 3.6%. 3.6. We're quoting 7. We're quoting 7. You take the outstanding mortgages out there at the moment, and the effective rate is 3.6, there and thereabouts.
Yeah. How many people are actually taking out at 7?
But to your point earlier, I think in the last hour, at what point, if mortgage rates come down, does the national frenzy begin again?
He said 5.5%,
Yeah.
5 to 5.5%. Maybe you start to see a lot more action.
The latest read, just to update that, no longer 3.6, 3.74.
Oof.
So just creeping.
John,
I know.
Sorry.
I think Lowe's has a better display than Home Depot of artificial trees. The 7.5-foot Hayden Pine.
How much?
Pre-lit artificial Christmas tree with LED lights, $328.
Oh, pricey, way more than mine. Like twice the
fancy.
price.
That's also
Deluxe.
pre-lit.
Mine's pre-lit.
Really?
Lights, yeah, built in. 150.
Oh, Lisa, you have no idea.
The Federal Reserve is done in terms of raising interest rates. They're going to be on hold till the back half of next year.
Even if we're on something that ends up looking more like a soft landing trajectory eventually, there wouldn't be a lot of urgency for the Fed to cut rates.
I actually think the market's moving in the right direction in that by May or June, they'll be able to cut rates.
The economy will likely slow down from where we've been.
These central banks are data dependent, and therefore, we don't get the forward guidance. Therefore, perhaps there's more scope to be surprised.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. We're getting out the Dom Perignon 2012 for the NVIDIA earnings report that we'll see tonight. I mean, we talked earlier, John, about NVIDIA. What if they miss? What if they beat? Like, actually beat?
I know.
What does that do to the Magnificent Seven?
2012, by the way, great vintage. Great vintage. You'll enjoy that bottle.
I thought it was vintage, excuse me.
NVIDIA, after the close, gains year to date of more than 240%. We're on a 5-day winning streak on the S&P 500. To see the NASDAQ yesterday close at 22-month highs.
The way it closed.
22-month highs. Record highs, Microsoft. All-time highs, NVIDIA. Savita Subramanian, Bank of America, publishing their outlook just moments ago for 2024 year-end, 5,000. Tom, this is what they've got to say. We are past maximum macro uncertainty. The market has absorbed significant geopolitical shocks already. And the good news is we're talking about the bad news. We're bullish not because we expect the Fed to cut, but because of what the Fed has accomplished.
Somebody talked about the many walls of worry. I believe it was Ben Layler, maybe somebody else talked about the walls of worry yesterday. Remember, like 2 cups of coffee ago, Apple was going to die because of China, and Apple's not at record highs, but getting there rapidly. I mean, the worries just seem to be drifting away.
Well, it's been a punishing market, Tom, because even if you've called Apple correctly, basically gone to no growth for the core of its business, China has been a struggle, yet the stock, Bramo, has gone in completely the opposite direction, which is kind of what the rest of big tech has done so far year to date.
Winner take all, right? And at what point are we seeing the dominance of the big tech and of the big names just in general? And at what point is this just showing the divergence between these names and the rest of the economy? Because the rest of the economy is showing some real signs of struggle, which is what we just heard about from Michael Collins over at PGIM.
We try to get out front here, and I saw in the Zeitgeist yesterday someone predicting we would see a lot of credit issuance. When you look at spreads, Lisa, even with rates not where they were 18 months ago, is it opportunistic for big corporations to unload the billions and issue out?
Yeah, we've seen the new issue market open up, but to Michael Collins' point, right, have people gotten over their skis with this idea that rate cuts are a good thing in terms of why they are happening? A good thing for risk assets. And that, I think, is the question we increasingly need to ask. Have we priced out the bad news that's required in order to get rate cuts next year?
John, real yield emeritus here. As I think for 2024, I can see you elbowing Greifeld out of the way and getting in there on the real yield. I can't keep track of who it is, but it's going to be Eric, our floor manager. But the answer is I'm looking at the real yield, and if I get what Wilson was talking about at PGIM, 2.11% real yield 10-year. You give me a 180 on that? What does it do to our belief?
I want to pick up on what Lisa's talking about because I think ultimately it's critical. It's not just about whether the Fed's cutting interest rates or not. You have to think about the why. The why is far more important. Not all rate cuts are created equally. If this is about disinflation and maybe keeping real rates consistent and not being overly tight, and you're delivering some of those surgical cuts, those words coming from Neil Dutter over at RenMac, great, you might be able to say that's constructive. If these rate cuts are coming because the economy is deteriorating, something is happening on the demand side that is not that good, this is what Mike Collins is talking about, Lisa, over at PGIM. If that's happening, if it's the latter and not the former, the call on credit is different. and it's not as good.
Which is the reason why we all picked up so much on Walmart's comments that the outlook for consumers had deteriorated materially over the previous 90 days, which is the reason why I'm interested in some of the retailers reporting earnings with disappointing outlooks going forward. How quickly are those outlooks changing as consumers start to pull back?
That's real GDP coming in. You look at Atlanta GDP now, I believe it's a sub 2% statistic. You're going to get that. And if you get disinflation, all of a sudden you get a nominal GDP well under 5% or maybe lower. And that's where this new worry comes up in a market that, right now, futures -10. Come on, John. When do we go green? 10 a.m.?
We're negative 0.2%. The fate of this market for the rest of this week may be in the hands of some Fed speak and Nvidia earnings. I'd throw in jobless claims as well. We've talked about that repeatedly in the last couple of days. Claims, Tom, tomorrow morning.
Yeah, I'm going to punch that up here. You can do this on the Bloomberg Professional Service. The 4-week jobless claims, I got a statistic of 220,000. That's still a boom economy.
Well,
we've got ways to
precisely.
go.
When we've asked this, Tom, we're coming off exceptionally low levels. You still focused on that, or are you going to start to look at the change? And I think for many people, Tom, you've got to look at the change. It's picking up. It's moving in the other direction.
I look at a polarized America, and I'm going to look sector by sector. And as I mentioned in the last hour, I'd love to learn more about energy and banks. Let's do that. We can do that as large as Texas. Victoria Fernandez with his chief market strategist at Crossmark Global Investment. I have no idea how you reallocate, rebalance Victoria for next year. What's the Crossmark strategy?
Yeah, well, Tom, as you know, throughout the last year, when a lot of people were trying to make the decisions of whether to be in or out of the market, for our clients, we were completely in the market, but we were being very cautious as to where we were putting our money to work. We had a lot of defensive names in our portfolio while still having a little bit of cyclical names in there. And our strategy hasn't changed tremendously. On days when the equity market is up right now, because we don't think that we're in this solid bull market right now, we're trimming some names and we're going in to some of the names that have pulled back. You mentioned energy. That's one area where we've been adding some exposure to names like ConocoPhillips. We actually are adding into healthcare too. Healthcare has been decimated, but you look at the balance sheets of some of these companies and you have a lot of opportunity there. Adding a little bit of fixed income, having a little bit of cash, using some alternatives in your portfolio like covered calls. We think this is the time when you really need to have that diversification and be ready, because we think there's still quite a bit of volatility to go.
Do you get uncorrelated diversification in fixed income right now versus equities?
Not as much as you probably used to, but what you're going to be using your fixed income for right now is for the cash flow for our clients. So you can get a 5% yield on the short-term part of the yield curve. It's an opportunity to have something a little bit better than cash, a little bit better than government agencies. You can lock that in for a short period of time and then add a little bit, Jonathan, on the longer end of the curve where you can have that longer steady cash flow over a longer period of time to help buffer any equity volatility.
When you look forward, there's a real question about whether rate cuts next year are good or bad for risk. How do you think about that at a time when people are expecting the soft landing as the base case?
So I think there is a misconception here that the Fed is going to cut in the first half of next year. If you look, Lisa, over this hiking cycle, we've already had 6 dovish head fakes where the market has gotten ahead of itself, assumed the Fed was going to be more dovish than it was, and they've had to price that back out of the market. I think we're seeing a little bit of that now. I don't expect the Fed to cut rates until the second half of next year, and I think it will be more because we're seeing a deterioration in the economy than it is because of inflation expectations. I mean, look at delinquencies right now. We're back up at pre-COVID levels in regards to autos, in regards to credit cards, especially in that 18 to 29-year-old age group where they've got student loan debts coming as well. And as delinquencies go up at a time with very low unemployment, what does that mean for banks? It means they're going to increase their loan loss reserves. It means loan growth goes down. These are things that are going to stymie the economy. It's going to stymie the consumer. And I think that's where we're going to see rate cuts come in.
So when you take a look at your risk appetite heading into next year, do you think that people are overly optimistic about both rates coming lower and equities continuing to do well, led by the names that have done best this year?
I do think there's a little bit too much optimism right now, and I'd like to be optimistic. I like to say good things are going to happen, but look, we've said for the last year, you've got to be cautious. You look at leading economic indicators down again. Even coincident economic indicators are flat right now. Consumer is weakening. You've been talking about Mr. McMillan's statement about deflation going on and worries about the consumer. We've heard it in the retail earnings that have come out. And I think you're going to see some of the things that have been propping up the equity markets, like buybacks, start to come back.
But Victoria, you're living in Texas, the Austin boom. And the Austin boom, is a broad sense, is service sector and technology. How do you underweight the Magnificent Seven?
It's a tough decision to make on what you do with this Magnificent Seven. Obviously, the AI tailwind to those names has been tremendous. And we assume NVIDIA is going to report good earnings, and that's going to continue then to lead that narrative and help that Magnificent Seven. You have to have exposure to these names, you do. But I just think you have to be a little bit cautious and putting all your eggs in that basket. If you have, you've done well this year, so I can't deny that. But as we assume that we're going to have a pullback in this economy and the consumer is going to come back and capital expenditures and spending by corporations is going to slow down, I think you have to be a little bit concerned about what those earnings look like going forward. So have your exposure, but like we said, add that diversification in other areas as well.
Victoria, thank you. We've got to leave it there. Happy Thanksgiving. Enjoy the next couple of days.
Happy Thanksgiving, guys.
Thank you. Victoria Fernandez there of Crossmark Global Investments. I've shared this quote with you a few times already this morning, but for those just catching up, this from SocGen in their outlook on that narrow breadth, the dominant leadership of a handful of stocks, 7 names, the Magnificent Seven, as they've become known. The narrow breadth in equities will likely continue, Lisa, until a recession begins, the Fed rate cuts become more prominent, and the yield curve is firmly in positive territory. That's the call, the timing. Most of these triggers are set to be backloaded in 2024. So be constructive here. SocGen's basically saying the dominance of this narrow tech story is going to be where it's at.
Isn't this kind of the reversal of what we saw a year ago? Heading in, pain in the first half, and then gain in the second half. Oh. It was just gain and gain.
It was dip and rip.
Yeah, exactly. It was dip and rip. Then it was rip and dip, and then now we're looking at, rip and then dip. I guess back to that narrative. I mean, that's.
Are we done with good news, bad news, bad news, good news?
I've got no idea, Tom.
I'm losing focus.
Stuart Kaiser, Citi. He's sat around this table multiple times with us. He said it a million times. It's a rally built on a good economy. And he thinks when the economy turns, laser focused on claims and continuing claims, Tom, when the economy turns, he's basically saying you want to get out. You get out fast. Be quick.
That's one of the opinions there. And then you still get this stunning 5,000 Bank of America.
I know.
5,400 Yardeni. How many more of these are we going to see? Is the new 4,700, 5,000?
I don't know who we're waiting for. I've sort of lost track of it all.
Is Mr. Wilson going to make an appearance? I've been waiting.
We need to catch up with Morgan Stanley. He's out with his call, though, yeah.
Oh, yes.
Minimal upside. Yeah. Minimal upside.
Okay. So he reaffirms a belief that it was smart. 8 months ago, he was the king of the hill. Tough business.
One bad earnings report from NVIDIA and a hawkish Fed. And
it's like getting on board with the tots and then everybody gets injured. I mean, James Madison, it's crushing.
Just to get everyone up to speed with the scores, not the football scores. Equity futures on the S&P negative here
Detroit Lions
by 0.2%. Aren't they doing all right?
The Detroit Lions, Michael Barr will tell you, the great Michael Barr of Bloomberg
Detroit sports
Radio,
isn't terrible this year.
8-2, first time since 1962.
It's been that long.
It's been that long. That's how bad they've been.
Why have they been that bad?
I'll let Michael Barr answer that, but the answer is politics of the four. It's like the New York Giants. It's a family-owned kind of team, and it's just been a challenge.
I love
to say
listening
the least.
to him talk about it. He just starts basically like screaming
into
the microphone. He just is like, it's ridiculous.
We're talking about Michael Barr here.
Michael Barr.
Okay.
This is not the vice chairman of the Fed. This is, he looks like him. The Michael Barr of Bloomberg Radio. I mean, he walks down the street in Detroit. It's like he's Mitch Ryder of the Detroit Wheels.
He's a superstar.
He's like, it's like
it's the voice.
It's a,
it's so buttery and pure. It's just magical. I agree.
He does Bloomberg Business of Sports. He's doing an entire show on AC Milan just to keep Ferro happy.
Am I allowed to attend said show?
Sure.
I'd love to come on and discuss. Yeah. I'd love to do that.
You could sit in the audience.
No, just sit and watch. I'll just listen.
See what they have to say.
Damien Sassower, Scarlet Food.
Greg Valier of AGF Investments.
Oh, good.
Coming up next, we'll talk to him about the latest in the Middle East, the prospect of a truce.
He goes out
of truce.
He goes out and shoots the damn turkey.
That's a very different story.
New Hampshire,
well,
New Hampshire woods.
Maybe we'll have that conversation too. I mean, I've got no idea what you're going to do. From New York, this is Bloomberg.
I don't think there's any doubt in my mind that if the opportunity arose for Israel to send their special operators in to get these hostages, that they would wait for negotiations. No, in fact, I think they're very much against any kind of ceasefire or humanitarian pause in the first instance. This is something that's being pushed by Qatar, by Hamas, and candidly, the United States.
That was retired Brigadier General Mark Kimmett speaking on balance of power. The latest on this conversation, the reporting led by Axios this morning, as they would say the state of play. Two sources with direct knowledge of the talk telling Axios that as part of the hostage deal, Israel would release 3 Palestinian prisoners, Tom, held in Israel, for each Israeli hostage released by Hamas. There's 2 phases to this, but that would ultimately be a summary of events, Tom, that could take place as soon as today.
And with the huge narratives, as soon as today is the key point here. We're really hanging on this by the minute. I mean, the bottom line is I think the entire people following this, the entire press corps is waiting really by the minute.
It's the latest reporting. Anne-Marie cautioned that we've talked about this many times, but if you do get this today, Tom, by far the biggest diplomatic breakthrough of the last month.
It will be, and it's, to hear Mark Kimmett talk about it, the former general with some real world experience here. And if you imagine the military operation in Gaza going further, Kimmett has been just visceral about the violence of going building to building.
To Kimmett's point, Israel has been against any kind of ceasefire. The reports today are about some form of multi-day ceasefire, Tom. So it will be very interesting to see if this comes together.
We'll have to see how that goes. Right now, on politics and on the moment of this election, on top of us, January 23rd, I believe, in New Hampshire, is his New Hampshire. Greg Villiers joins us, Chief U.S. Policy Strategist at AGF. Greg, 8.3 million new voters will be eligible in 2024. They age into their ability to vote. What's the history of 18 to 22-year-olds showing up?
Well, it's often been disappointing, Tom, but at the same time, this is a big number. And there's an issue that has really motivated young people, and that is the war, the Hamas-Israeli war. Polls show that overwhelmingly young people are opposed to the Biden policy. Biden's poll numbers are dropping fast, as you know. So the young people coming into the system will put pressure, I think, on both parties to reach some kind of settlement.
Do those young people want to vote for the former president?
Donald Trump? No, not necessarily. I think of most young people right now would say none of the above. But I think that on many fronts, you have to say that Joe Biden is not connecting with young people, whether it's Taylor Swift, the gaffe that Biden made yesterday, or whether it's far more serious issues like this war, like what's going on campuses. I can't defend a lot of what's happening on campuses, but I live in a city that's addicted to the polls, and the polls show real movement among young people.
We've been talking about this for a while, Greg, and it only has become more so as the polls continue, and you can name the reason why, but it's been a consistent trend of a deterioration in Joe Biden's popularity. How serious are the discussions getting around getting a different nominee to take his place?
I think this reached a turning point, Lisa, over the weekend, in which Biden profanely criticized his critics, and I think that he has made it clear that he is not dropping out. I would be very, very surprised. In many states, the filing deadlines have come and gone, so I think he's in. I think it's Trump versus Biden, and that's not a real palatable choice for an awful lot of voters.
Joe Manchin has been making the rounds, and he's flirting with potentially running for president as an independent, talking about how neither president really is gaining traction with potential voters, former president and the current president. From your vantage point, do you think that there is a viable independent candidate who could actually win versus just take votes from one or the other of the potential candidates?
Yeah, going back to my home state of New Hampshire, and there's a poll that showed Robert F. Kennedy Jr. at 22%. That, to me, was astonishing. One other thing that I don't understand, frankly, the New York Times had a big front page story this morning about the disconnect between how the economy is doing, low unemployment, inflation falling, and how people view it. People's view of the economy does not fit with the data at all.
Okay, it doesn't. Why is that? I mean, to my great theme, Greg, for this year, and I'm stealing this from Lal Brainerd, it's a cumulative in inflation. I mean, CNN just had it on, folks, the Justin Wolfer's thing we saw on Twitter. The price of Thanksgiving dinner is down 4.5%, but it's up 25% from 2019. To me, Greg, that explains the electorate.
Yeah, exactly. This disconnect, if it persists, will be still another huge albatross for Joe Biden in his re-election effort. Maybe next year, if inflation is clearly falling, things will change. But I think right now, an awful lot of Americans still are nervous about inflation coming back.
This inflation, Lisa, I can't say enough how, we're weaned on month over month, 3 months annualized, year over year. Throw it out the window. I see anecdotally every day from every person, it's a reset from December of 2019, maybe February of 2020.
So let's connect this to where we started the conversation, which is the war between Hamas and Israel. Greg, by next year, is it going to all be about the economy, or is still there going to be this hangover that we see currently that's really eroding some of President Biden's popularity?
I think by the end of the year, the war will be over. There might be scattered resistance, but I think that outcome is inevitable. Sadly, that's not the case in Ukraine. But I would say the war is still another source of anxiety that Americans have, and I think they feel that Washington is not listening to those concerns.
Do you have a sense of what people want to happen, of what would be considered a positive, both just humanitarian but also political outcome for for this war?
I think people would like clarity. If this war does not end conclusively and it drags on, I think that would be extremely unfortunate. And I would say this, I think Netanyahu and the Israeli intelligence community has to answer for the fact that they got totally blindsided. This cannot happen again.
So many questions still about that more than a month later. Greg, thank you. Greg Valliere there of AGF Investments. Just slightly distracted by some of the headlines crossing right now. Netanyahu, we are making progress on the return of hostages. I hope there will be good news soon on hostages. Those comments, and we'll keep an eye on those headlines as they cross, following this reporting from Axios. A deal between Israel and Hamas to free dozens of hostages and declare a multi-day ceasefire is imminent, Lisa, and could be announced by the Qatari mediators as soon as today, according to two sources with direct knowledge of the issue.
What I find interesting is where the pressure is coming from. We were talking with Anne-Marie earlier, and she was noting that Israel has said that it doesn't want a ceasefire of any type until Hamas is eradicated. At the same time, internally in Israel, there is so much pressure to get the hostages home, and there's also growing pressure against Netanyahu's leadership because of so many people and how unpopular he is, and some of the mistakes and frankly hardline approaches.
I thought Anne-Marie Horton was great there. We have to be clear, it's not quote unquote all the hostages. We're only talking about a small group of them. That's better than none. But this is not like other hostage discussions where it's all the hostages.
The number that Axios went with in phase one was 50.
50.
Tom.
Out of
50.
200.
And then maybe another 50 in a second
Yeah.
phase, but certainly not all.
Yeah, that's the key thing here. And the other thing is the military effort as they move from north to south in Gaza. I mean, horrific's the only word I can come up with. The images and the maps and, the rest of it.
You have to agree. It's just been tragic all round over the last 6 weeks or so.
There's no other way to put it.
Conversation continues in the next hour on Bloomberg TV. We'll turn to the markets. Emily Rowland of JH Investments, Brian Levitt of Invesco. Brian Levitt, I remember this line from Brian earlier this year. I'm a FOMO guy. I'm a FOMO guy. And in the moment he said it, I just started laughing. But guess what? His fear of missing out made sure that he did not miss out.
But he's on
this market.
He's on because of Michigan, Ohio State, right?
Is that right?
I mean, that's to get a brief.
I mean, I can ask him about it if you'd like.
He did.
And then Gersten Distenfeld as well. We'll talk about credit. That maturity wall out there, Tom, in 2025, and whether these companies are going to use this move lower in yields and these tighter spreads to opportunistically, Tom, issue some debt and get ahead of it.
And trust me, I'm an amateur on this. I can't wait for Gershon to speak. They have a wonderful joy in issuing debt here. It's a no-brainer to take debt of 8% or 4%, these stupid percentage numbers, and get it out to something that's in the textbooks.
There's a window there. It's about whether they take advantage of it and how long that window lasts. Thank you, buddy.
That's good.
I appreciate it.
That's good.
Team effort.
You working on the sides to start today?
Yeah, mac and cheese. Nice.
Really?
No.
Bloomberg Surveillance, good morning. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. Mr. Ferro on assignment. He's working on his side dishes. He's starting them in here before the 9 o'clock.
He has mac and cheese.
He's got mac and cheese, and we're debating potage here. And you got to go with the mashed potatoes, and it takes days of preparation.
Sweet potatoes with marshmallows on top.
It's un-American.
That's not un-American. It's classic American.
We'll be with you tomorrow, Wednesday.
Cookie
I don't
channel.
think we're here Thursday.
No.
And then Friday's a toss-up.
I'm here alone. You guys are going to ditch me in the sides.
We're going to see. It's going to be an interesting week with a huge economic data dump here. Tomorrow, we squeeze 3 days into a holiday Wednesday here, and we're going to talk a really important conversation with Citigroup here in a moment. But right now, our Michael McKee, our international economics and policy correspondent in charge of Thursday football, as well. Mike, I guess Thursday football, Thanksgiving football, is more interesting than the economics today. We wait for the data dump tomorrow. What do we need to look for tomorrow besides claims?
Really, claims are what you're going to be looking for. Durable goods orders will be interesting to see if businesses are still spending. Those get revised once we get the factory orders numbers, so they won't be definitive. Claims, obviously, people want to see if the 231,000 we got last week was holiday caused or some sort of oddball number, or whether we're really starting to see a larger and larger group of people getting laid off. So a lot of interest in that tomorrow morning before people hit the road to go home and watch football for Thursday. Today we get the Fed minutes, and it'll be interesting to see how many people really care if the Fed minutes give us anything besides what we already know.
Frame that out for us. Help me, 3 weeks old? How old are the minutes?
3 weeks old. They're
is that
3 weeks
ancient
old,
in your world? Is that ancient?
It's definitely ancient, especially now, because since the meeting, we've had the jobs report, the CPI report. We've seen but a major reversal in the jump in interest rates along the yield curve, which may have been a reason that the Fed cites for why they might want to have held rates where they were at the last meeting. So a lot has changed since then. There's a lot more new data. I think what people will be looking for is any kind of criteria in there, criteria for whether they raise or lower rates, or criteria where we can try to figure out what they mean by longer in higher for longer.
I've been really interested in the economic data that I've gotten from retailers this morning, the sense that they've been talking about the consumer and waning demand. We're looking at Best Buy, seeing what they call uneven consumer demand this morning. This was part of the reason why they cut their forecast. We heard similar types of messages from Macy's, Target, Gap, also, of course, from Walmart. Mike, how much is there this divergence going on with ongoing weakness in goods sectors, even with resilience in the services?
Well, it's been going on for a while, and it's likely to continue. The question is, do people really intend to slow their spending, or are they going to time it differently? There's some thought that what maybe people are waiting for is prices to drop. Retailers have suggested, and Walmart was the one that got a lot of headlines for this, that we might see prices go down during the holiday season, and that would mean that people might hold off on buying. Last year we saw a jump in October sales. This year we didn't see that. So maybe people are waiting, or maybe indeed a slowdown's underway and people aren't going to spend as much money.
Michael McKee, thank you so much in Washington. This is a joy, and we look back, and we rarely do this. You look back at the people that tanked, you look back at the people that were successful, but we can say without question that Citigroup has had one hell of a year in forecasting the American economy. Andrew Hollenhorst and others, a broad team, have just hit the ball out of the park on higher rates, and some of the nuance change here right now. Driving the ship at Citi, their global economist is Robert Saga, and he joins us right now. I want to go to the heart and soul of your economics, and I would say the heritage of Catherine Mann and Willem Wouter as well, which is you studied under Salah E. Martin, Xavier Salah E. Martin at Columbia, and he is, in my opinion, without question, the growth optimist of generation of economics. Do you share Salah E. Martin's just sheer optimism on global growth?
I do. I think long run economic growth can be really benefited by growth in productivity, innovation. There's a lot of scope to do a lot of good, and that he always taught me that it's not a zero-sum game, that the pie can be divided more equally globally. I think for the next year, something we've been highlighting is more pessimism, that we think global growth is going to be quite soft as we head into next year. That's more the cyclical factors that we face. So we do think we're in for harder times ahead, but broader term, long term, absolutely an optimist, similar to...
So you would push against the IMF's 2028 call of subdued global growth, and that somehow, as Salah Martin and others would say, somehow we do generate growth from other factors that surprise along the way.
Yeah, we think right now we've seen a lot of resilience in the global economy. So if you went to the end of last year, we thought global growth this year would be running somewhere below 2%, about 1.8. We're tracking about 2.5% in market exchange rate. So a pretty big upside surprise. Most of that has been due to the U.S., but we've essentially shifted that weakness out into further quarters because we think that post-COVID services momentum is starting to fade, that those interest rate hikes are going to start to bite more as we get into next year, and that manufacturing weakness that we see globally is going to start to undercut activity more broadly. So we are holding on to that slowdown, but we've been surprised to the upside throughout this year.
So let's talk about not the longer term and the optimism, but the shorter term and what you just said, which is you do think that we're in for harder times ahead. What does that look like at a time when people are expecting this gentle slope upward in the unemployment rate and just sort of a general decline in consumption until we get the rebound? Do you push back against that view?
Yeah, we think that eventually these interest rate hikes are going to have to bite more. You're starting to see some evidence, even in the U.S., where the data have significantly surprised us to the upside all year. That's been the source of most of the upside markups in our global growth forecast has come from the U.S. But you are starting to see some cracks. So you are seeing credit conditions that have tightened significantly. We've done some work that say that tends to play through the economy over a 2-year period. So some of that may still be in the pipeline. And you're starting to see some strains on the lower income consumer side, where you're seeing rising subprime delinquencies, rising credit card debt. They've drained most of their COVID excess savings. So we think more of those things are going to start to bite going forward. But that being said, certainly the probability of a soft landing has gone up materially. We've seen a lot of these factors stay just yellow warning signs and not red warning signs.
Which is the reason why I guess people are trying to understand whether this is like all the other times where it becomes nonlinear and you start to see unemployment pick up in a more material way, or if this time truly is different, given some of the discussion from retailers and the forward look and how quickly things are moving, whether it was Walmart, whether it was Best Buy today. Does that make you feel like something is happening more quickly in terms of deterioration?
Yeah, absolutely. And to that nonlinear point, if you look at the history of cycles, the labor market tends to turn towards the end of a cycle, tends to move very rapidly after a period of relative stability. And if you look at the lower income consumer segment that I mentioned, when they pull back in spending, it tends to be very sharp and very quick. So I do think you could get this nonlinearity, which is why it's very hard for economists to call recessions. So that does worry me, but at the same time, the resilience we're seeing has been, very encouraging. We're seeing stronger growth and inflation coming down more quickly.
This is critical because everybody looked at the Hollenhorst call and said, this kid from UCLA is nuts. It's not going to happen. And if it does happen, we're all going to tank and the world's going to die. And the core issue here is we got the Dudley, L. Arian, Andrew Hollenhorst Citigroup call, and we didn't die. I mean, that's Econ 101. Sometimes you get lift in rates and it actually benefits the system.
Yeah, and to Andrew's credit, been very far ahead of in this cycle, calling things early and calling things very right. And I think to your point, we really haven't seen the effect, especially in the U.S., of these higher rates yet. If you look at mortgage rates, for example, well above 7%. The effective mortgage rates in the economy has been closer to 3.5% because so many people are on fixed rate mortgages. Corporates termed out debt throughout this cycle as well. And you had that excess savings story where consumers, particularly in the U.S., built up a lot more savings throughout the cycle, and we still think there's a fair amount of that left. So, rates have gone up a lot, and as you said, growth, accelerated in the third quarter.
Let's get you in trouble here. I mean, Clarida was Dean of Economics at your Columbia. He's saying there is a new R-starred. Are we going to go back to John Williams' 2%, or can we settle out anchored at a higher R-starred, a new imputed inflation into the system, if you will?
Yeah, and that's certainly a big debate. Our view has been that the post-COVID world is going to look mostly like the pre-COVID world, and so R-star hasn't moved very much. But maybe what you're seeing is exactly that the economy has held up so well because it can, sustain a higher level of interest rates. And so that's certainly a key part of the debate.
What data is most interesting for you in the next 2 months or next month and a half that we have in the remainder of 2023? I
would say two factors. One is wage growth. Can we still see wage growth continue to cool from very elevated levels? We think that the Fed's comfort zone for wage growth is 3 to 3.5%. It's still running 4 to 4.5, depending on the measure. That's down from near 5.5% at the cycle high. So we've come a long way down, but there's still a long ways to go. So I want to see if that wage growth can continue to cool. And then consumption. We've seen enormous upside surprises from the consumer throughout the cycle. Can that continue?
Robert, thank you so much. Robert Sockin with us with Citigroup, their global economist. There's some form of breaking news here, Lisa. I want to read it verbatim to be sure I get this right. This is Politico within the maze of rumor and speculation, and the operative word is has. The United States has brokered a deal between Israel and Hamas to free dozens of hostages held in Gaza in exchange for a 4 or 5 day pause in fighting, according to two current U.S. officials and a former U.S. official with knowledge of the talks. They hedge that nicely. It's a speculation of war, but certainly in the wonderful timing of having Robert Hormats with us here in a moment, that is good news.
And in tandem with some of those headlines, we're seeing other headlines from other sources that the Israeli cabinet is going to meet in the next few hours to review the progress on hostages. So it does feel like it is live and actually happening in a more material way than has been over the past couple of days.
Widely rumored through the day, but then you wonder where this goes into the weekend and the length here. They do mention a 4 or 5 day pause, which I'm not sure what you do with that besides humanitarian aid.
Well, humanitarian aid and getting some of the hostages out. Just to be honest, all of us are looking for a resolution, for an end to the death, for an end to the hostages, for an end to some of the destruction in Gaza, with some resolution potentially in the works.
See on that, we're thrilled that Ambassador Hormats will join us here in about 3 minutes. You'll want to stay for that. The Standard & Poor's 500 down 13 points, down 0.3%.
I've got to say, when we have this conversation with Robert Hormats of Tiedemann Advisors, there's a real question here, both internationally but also domestically, and we've been talking about it throughout the morning, but how the U.S. is sort of influencing some of these talks at a real fraught time, and one where there's a lot of disagreement, frankly, within even the Democratic Party about how to proceed.
And with the death of Rosalind Carter and the fragility of the former president, the images of Jimmy Carter with Anwar Sadat and others, I mean, to harken back to 67 and then all that was done many, many years ago, you wonder how those images will look forward if we somehow extricate ourselves from this.
We're going to get to talk more about politics in the next, 12 months. Well, it's going to heat up. We're going to have, it's going to become more and more of a focus. Will markets care? I mean, this is sort of one of the questions. Is it going to be all about the deficit? No, I think they've proven they don't. Well, except unless there's a bond auction and then all of a sudden they care a whole host more. And there is this question next year how that's going to heat up, especially without any resolutions coming on the debt story.
West Texas Intermediate, $77 a barrel. Brent crude, $82 a barrel. Pretty much unched there. I'm not going to say much about that. I do want to point out the 10-year real yield with a shock early this morning, 2.11 is lifted, 2.15%. I brought this up yesterday. Nobody's listening. Do we revisit 5% 2-year yield? Nobody's looking for that.
Yeah, and at the same time, it's creeping a little bit higher. You're right. You're right to raise that.
Yeah, well, we'll have to see. Dollar weaker as well. Ferro's looking at the euro. 109.45. He's going for the big bird with Thanksgiving. He's living large with sterling 125.
Just the breast. Didn't he say just the breast? He just does the breast.
It's just, you know.
I like dark meat.
Coming up,
I do.
Robert
It's
Hormats
better.
on Israel and Hamas.
We do want to get the latest on some of the breaking news. We are hearing that there has been some sort of resolution, some sort of agreed upon truce, or at least a ceasefire on the part of the Israeli-Hamas war, and some return of hostages. Let's just get the latest. Anne-Marie Hordern joining us here, who's been covering all this for us. Anne-Marie, what do we know?
What we know right now is that they are very close to a deal. And I have this, so do some of our colleagues from a number of sources, whether or not it's the United States or also in the Gulf. This would be for potentially as many as 50 to 100 hostages that were taken by Hamas. We know that's around a number of 240. So this would be 50 to 100, only women and children. It would come with a number of days of a pause, potentially 4 days of pausing of what is going on in Gaza with these Israeli bombardments. On top of that, it would also mean Palestinian women and children would also be released from Israeli jails. And we can see this as soon as today. My sources are saying it is very close. And I would read some of the tea leaves from officials. We heard from Ismail Hanai. He is the political leader of Hamas that's based in Doha. And he came out on Telegram saying they're very close to a truce. And then the president yesterday said they were close. He didn't want to lean too much into it because obviously when you're dealing with hostages, these deals can break down. For many weeks, I was very close to being able to reporting something, and at the last minute, the deal broke down. But the president yesterday went like this, put his fingers up, crossed, and Admiral Kirby said it's the closest we've ever been.
One question quickly before we get to Ambassador Hormats. What happens after 4 or 5 days?
It's a great question. We don't know yet. I think many people...
It's a prosecution of a military strategy, right?
Well, many people want to see the bombardments to slow down. There's a lot of pressure on Israel. Israel didn't want to do any sort of ceasefire or pause, even though they're different. Didn't want to do anything until the hostages were released. But they realized that these hostages were not coming out unless there was a pause.
To be followed through the day, please stay with Bloomberg all day. And sometimes you get lucky, and we do that always with Robert Hormats. He is of Tufts, and he's of generations of presidents. This could easily be a 3-hour conversation, Ambassador Hormats, with the Yale School of Management. So many narratives. Bob, you and I could go for 3 hours right now. We got about 7 minutes. There's James Earl Carter with Sadat from another time and place. We have a nostalgia for that moment that you lived and the success with Brzezinski and the rest that you lived. What imagery are we going to see when we extricate ourselves from this war in Gaza?
Well, I think at that point there were two interlocutors that Carter was trying to pull together and was able to do that. Now you have a much different environment. You have Hamas, you have the Israelis are divided. Hamas is a very inchoate kind of operation. You know, it's not quite clear how much power the center of Hamas has. It's a very dispersed organization. And we really, with hostages, as you've correctly pointed out, you really don't know until it's actually done. Remember the movie The Bridge of Spies? They didn't actually know that the transfer was going to take place until it did. They arrived. And I think these things are very sensitive. But what's very important about this is that the United States and Qatar have played this intermediary role, which I think is constructive, and that it gets the United States back into the game in a positive way.
Robert Gates, my essay certainly of November in Foreign Affairs magazine, it's a primal wake-up call on American diplomacy is being efficacious. You have said this for decades, Bob Hormats, that we can't let down our diplomacy. What does our next diplomacy look like after what we've lived the last 8 or even 12 years?
Well, that's the interesting point, that is, during the Cold War, diplomacy was Washington, Moscow, essentially. And now you've got lots of power centers. Obviously, this summit with the Chinese was, I thought, a very constructive summit. And actually, I'm going to China in a week. to talk about what kind of progress can be made to support what was done in the California summit, but opening up new opportunities, I think, for business and for diplomacy. But talking to a number of people about how we move the very constructive process that was begun there along. But you also have a variety of new power centers that you have to have very proactive diplomacy. India is playing a greater role, particularly in the global south. Iran's a power in the region. Saudi Arabia is playing a much greater role. So you have to have a much more agile and a much more diffused diplomacy. There are lots of power centers of different levels of power, but a lot more influential countries than there were in the past.
Which is the reason why there was a lot of focus on China's meeting recently with Arab leaders and wondering how exactly they were navigating something that they really haven't taken a particular stance on. What did you glean from that?
Well, that's a very good example of this. The Chinese really, for years, played virtually no role in the Middle East. They have a base in Djibouti, but that's sort of north and out of the framework. It's really on the tip of Africa. But they were not engaged in the Middle East. Then, sort of a surprise, we find that they brokered a deal between Saudi Arabia and Iran. So it's clear that they have a new positive, proactive, and I would say in that case, quite constructive diplomatic approach. They have very sophisticated diplomats. We shouldn't underestimate the quality of the Chinese diplomatic corps. They're very good. So they're playing a greater role, and the fact that we're now re-engaging or engaging in this diplomacy to help deal with the hostages with Qatar sort of shows that we're now coming back into the game and playing a constructive role. But we're going to have to do this in a whole lot of countries because there's a lot of power centers, and we're going to have to play a role, if we want to play a global role, in a variety of regions.
The more I read, the less I feel like I know about what's going on in the Middle East right now, in terms of where the power centers are, who's brokering what, how, whether Saudi Arabia is getting more sort of aggressive with Israel or not. Do you have a sense of just whether there still is this animosity between Iran and Saudi Arabia, of whether there is this move from Qatar and Egypt and others to move away from Israel? Do you have any sense of exactly how this tide is shifting?
It's very hard to read the tea leaves. I would say that Iran and Saudi Arabia probably still have a lot of questions about each other and a lot of suspicion, but at least they're engaging in conversation in a way that they weren't before. And I would say it's probably true as well. I do think that the Sunni Arab countries in the region did want to have and still do want to have a close relationship with Israel. This, and one of the reasons I think Hamas did this horrible thing is that it didn't like that was going on and thought this would interrupt that process. So I still think the underlying goal is to have a greater degree of normalcy between Israel and the Sunni Arabs.
You just celebrated your 80th birthday, and I think I can say between you and Michael Bloomberg, you are as well preserved as anybody I know. What's the damn secret to looking this good at 80?
Getting up early and coming on this show.
Okay, that's the right answer.
That's right.
I want you to talk right now about this crazy American gerontocracy that we're living right now. The president's 81, the other guy's 78. How did we get, half of Congress is 92. How did we get here, Bob Hormats?
Well, you've asked a question with really two powerful ingredients. One is we certainly need to begin to tap the younger political leaders, and there are plenty of very good people who are in the process of moving up in the political process. But the older leaders have sort of taken the oxygen away from them. They don't get to participate in a lot of the proactive debates that are going on because you've got two leaders who are older who take a lot of that oxygen, the political oxygen, and money away. But the second point that's even bigger is we have to start thinking a lot more of the implications of what we do today for the next generation and the next generation and the next generation. That particularly has to do with the budget because we're leaving our children and grandchildren with.
Well, this is your book from a couple of years ago. Right. When's the second edition out?
And
you got to redo it.
I just did an article for Fortune magazine explaining why this was a problem and what it was going to mean for Social Security, what's going to mean for the budget for contingent liabilities, and the numbers are up and up and up. Who's going to pay the interest? Our children and grandchildren. We're leaving them with a burden. That's one. Climate's another.
Breaking news is getting in the way. Bob Hormats, I got to cut you off. Thank you so much for joining us. Anne-Marie, to you, 20 seconds. Any breaking news here into the 9 o'clock hour?
Just that we remain very close to getting this hostage deal done. We also did hear from the Israeli Prime Minister, though, Benjamin Netanyahu, and the Israelis are tweeting that they will have a war cabinet meeting this evening.
Stay for this, and Anne-Marie Horton, Balance of Power. Look for that this evening. We say thank you to Robert Hormats of the Yale School of Management. Please stay with us with futures at -13. NVIDIA this afternoon.